There's no sign of that mass liquidation that people were talking about in the second quarter.
There is this hopefulness in equity markets that we are going to get through all the risks.
There is a huge amount of good news that's been priced in.
Small cap has had a few head fakes. We're finally seeing that all-time high.
We've actually seen a broadening of the S&P rally.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday on a 3-week winning streak, equity futures pulling back from freshly minted all-time highs as the US and China are working to finalize a deal over TikTok. President Trump is making a move to shake up the H-1B visa program. That visa coming with a big price tag.
Yeah, $100,000 per H-1B visa. Not ones that have already been issued, but ones that will be issued going forward. And a real question for how much this affects, in particular, big U.S. tech companies, as well as all of the other companies that use consultancies, largely from India, to get cheaper engineers. How quickly can they plug this gap, and how much are they going to continue to rely on the H-1B program rather than just look for domestic talent?
Or will some of these multinationals just decide, actually, we're going to set up shop somewhere else? Also, the legal concerns around this, usually what happens with visas is it's set up by Congress, it goes through regulations, and there is a public period of comment. None of that is happening. This took place yesterday. It came into effect. So I think there's going to be a lot of pushback potentially in the courts and maybe even from individuals in Congress.
There is an obvious challenge for anyone trying to put this policy together. Balance is really important. You want to address any potential or real abuse of the program, but balance that with maintaining access for really highly skilled workers. And if you go hard on the former, you can compromise the latter.
This was so confusing. It was rolled out in a hasty fashion. People were brought back from overseas to figure out whether or not they could get back to the United States. A real question here about how much this is permanent policy, how much this is trying to get leverage ahead of an Indian delegation coming to Washington, D.C. for meetings this week. A lot of question marks around this policy and exactly how it will get rolled out in the next couple of weeks and months.
It's your favorite week, isn't it? It's mine too. It's the end of summer.
You're going to put that on me?
The UN General Assembly comes together in Midtown Manhattan.
Yes, we're grumpy.
Things get
you guys
busy.
Are being facetious. I actually like Ingka besides the traffic. I think it's a great time to go out, meet people, get some dialogue going.
Did anyone think we're being authentic in any way, shape or form? I'm not sure they did. Equity futures on the S&P 500 negative here by 0.3%. We're a little bit softer. Coming up this hour, Andrew Sheets of Morgan Stanley as stocks look to add to record highs. Angelo Zino of CFRA as big tech braces for President Trump's visa crackdown. Plus, Krishna Guha of Evercore on a divided Federal Reserve. We begin this out with some breaking news, and it's on TikTok. With the latest, let's cross over to Tyler Kendall for more. Morning, Tyler.
Hey, John. Good morning. Well, a White House official says that Oracle will recreate and provide the security for a new version of TikTok's algorithm. Under the deal, owners of the U.S.-based version of TikTok will lease a copy of the algorithm from ByteDance. And then Oracle is essentially going to serve as the gatekeeper here, continuously monitoring and operating that algorithm. The official said that data will be kept in a secure cloud and that ByteDance will not have any access to U.S.-based users' information on the platform. The algorithm, of course, has long been a sticking point in these negotiations. And we should add, at this point, it's unclear if this will satisfy the national security law passed by Congress, though the White House is certainly hoping it will. An official tells us that President Trump is planning to sign an executive order later this week, cementing his approval of the deal, though worth mentioning also that we heard from China's foreign ministry on Friday, and they fell short of a full endorsement. As we've been reporting, the structure of a likely TikTok deal is going to take the shape, with ByteDance leaving with a less than 20% stake, and then the outside U.S. investors holding a greater majority, including companies like Oracle. The White House had announced over the weekend some additional details, too, that 6 out of 7 of the board seats will be held by Americans. That final seat will be held by ByteDance. John, as you well know, the backdrop to all of this are the ongoing trade negotiations with Beijing. But as our analysts at Bloomberg Economics point out, while this deal, this movement on TikTok perhaps helped to secure that face-to-face meeting that we're expecting between President Trump and Chinese President Xi Jinping next month, we're still well away from a fuller, broader trade deal.
Tyler, good to have you here in New York. Stay close, won't you? Bloomberg's Tyler Kendall breaking down that breaking news for us just moments ago. Annmarie, the pieces of the puzzle coming together. What's less clear at this point? What is ByteDance actually getting? What do they get in return?
Well, this is a great question because I think the Chinese have been obfuscating exactly what they're going to get out of this. Tyler mentioned, we heard from the foreign ministry on Friday. Part of what they said is that what needs to be done, they want to see a productive commercial negotiations with the United States, but it says that it needs to comply with China's law and regulations. Does a less than 20% stake actually comply with China's laws and regulations? Potentially, China's going to get something else they want in a bigger way that has nothing to do with TikTok in order for this deal to go through.
Has the U.S.-China relationship really gotten boiled down to TikTok dances? Is that what we're talking about? That the entirety of the U.S.-China trade relationship now has to do with people in the street going like, get ready with me?
Is that the dance? Is that your TikTok dance?
I'm just saying. This is amazingly how much we've lowered the bar for what could actually get accomplished.
It's amazing how successive administrations have not been able to deal with this head on. We've seen this going back to the president's first term, at the very end of it, granted. And the Biden administration couldn't deal with it. And now this is the third attempt to address this issue.
Yeah, and it's about the kids, evidently. That's what President Trump has talked about. But on a larger level, how does this fit into a larger U.S.-China trade deal? Or is this really just TikTok? And that is what we accomplished last week. And that's what we can accomplish going forward.
Oracle this morning up by about 1% in the pre-market. Angelo Zino of CFRA is going to join us in about 25 minutes' time on this story. For the broader market, here's the view on Wall Street this morning. Andrew Sheets of Morgan Stanley writing lowering interest rates into easy financial conditions raises the odds of a more speculative boom if growth does not weaken. Andrew joins us now for more. Andrew, let's talk about what that means for credit. Multi-decade tights on investment grade, high yield near the tights of the year. Andrew, are we starting to see that speculative move start to build?
Yeah, thanks. Good morning. So, look, I think you are starting to see early signs of it. And again, the Fed has a difficult job. The Fed's in a difficult position, but it's certainly taking a risk by lowering interest rates and saying it's still going to lower them further, despite inflation being above its target, other measures of growth holding up, large government deficits. And I think importantly, some very easy financial conditions. As you mentioned, spreads are near multi-decade tights. Equity valuations are near multi-decade highs. And I think importantly, we're starting to see M&A activity really pick up. We're seeing IPO activity pick up. We're seeing more signs of corporate confidence. So while those levels are still low by historical standards, they're certainly moving towards more activity. And that's a trend we think continues.
How does that square, Andrew, with the idea that we've gotten some negative economic news in terms of the non-farm payrolls report, some of the jobless claims data, albeit somewhat noisy? Does bad news equals bad news when you start seeing a deteriorating labor market?
Yeah, so I think this is what's so fascinating about the data at the moment is that you do see in labor market data and some other kind of traditional early cycle indicators, you really do see some weakness, everything from the jobs market to heavy truck sales. But you also see some other data that looks a lot better. GDP tracking measures are holding up. Retail sales have held up. And I think a really interesting one is if you look at commercial bank loan growth in the U.S., which is, kind of one of our favorite credit cycle indicators to follow, it's accelerating higher. And that's before we get, the expected deregulation of the banking sector, which we think is coming. So, I think the Fed is taking the view that, look, usually the labor market is the most important cycle indicators, the most important driver of recessions. It's part of the Fed's mandate. That's what we're going to focus on. But the data is generally mixed. And with changes to immigration and other policy, there are a variety of factors that could be distorting the labor market in unusual ways.
When you put this together, it sounds like, Andrew, there's a greater risk of upside to the economy, the idea of a reacceleration than there is some sort of downside, the idea that you could see a real further deterioration in the labor market. What's the implication of how far that can go? People have talked about bubbles. People have talked about already tight levels in credit. People have talked about the idea of a steepening yield curve. Where do you see the potential mispricing of such a reacceleration?
Yeah, so I think there are a couple of factors. So first, I think certainly for the credit market, the market that myself and my team follow most closely, of those two tails, the weaker growth scenario is, I think, the much worse tail than the more speculative boom scenario. That boom can take some time. And I think importantly, we're still, I think, in the very early innings of the type of M&A activity that we would expect if things really pick up. I mean, you're still below average in terms of levels of M&A adjusted for the size of the economy or adjusted for trend. So there's a lot further that can go. And I think for as much as we rightfully focus on higher levels of optimism, say, among retail investors, corporate optimism, corporate activity levels have not been elevated. And I think there's more room to go there. So companies that benefit from M&A transactions, some of those advisors, those are stocks that my colleagues on the equity side are more positive on. And, I also think kind of importantly, there are, this is a market that is still providing a discount to things that are smaller, more cyclical on the equity side in a way that's not true on the credit side. So again, I think this dilemma that the credit market has is that if you believe that things could get a lot better, there are lots of small, cyclical, more levered stocks you can buy at large discounts. But in credit, we're often already pricing those things at 20-year, 30-year lows.
So, Andrew, are we at a space right now where the Fed is cutting into what you view as a reacceleration of growth?
So I think that there's a number of data that's suggesting that's a real possibility. And again, that it might not even be a reacceleration of growth, but just if growth holds up, just if growth is kind of stable, then the Fed cutting into still above average inflation and rising inflation, the Fed cutting into these already easy financial conditions. And then I think also really importantly, the Fed cutting into what looks like a really historic boom in CapEx. The amount of spending that we at Morgan Stanley are expecting from the AI data center revival growth is just enormous. It's in the neighborhood of $3 trillion, we think, between now and the end of 2028. So again, these things might not be, 3% GDP type of numbers, but if the cycle can hold up for longer and extend for longer, there is this kind of dry tinder of potential for M&A, potential for more strategic activity, potential for more CapEx that could kind of heat up conditions in our view.
Andrew Sheets of Morgan Stanley. Andrew, thank you, sir. Appreciate your time. Andrew mentioned the equity side of the research team over at Morgan Stanley. Mike Wilson this morning saying pent-up demand, inflecting EPS revisions suggest the recession that some are now fearing is already behind us. Here's his question on the Fed. The question now is whether the Fed transitions fast enough, given what markets expect and or need for this new bull market to continue.
Right now, you've got a 92% chance of a Fed funds rate cut come October, in the Fed meeting in October. Then there's another one later this year. Is 3 enough? How many more is needed for next year? And what does that imply in terms of how much weakness there is in the underlying economy and whether Fed funds rate really is the tool to really address it?
A ton of Fed speak this week. You'll hear from the New York Fed President, John Williams, the chairman himself as well. Jay Powell speaking later this week too. If you are just joining us, welcome to the programme. Equity futures on the S&P just a little bit softer. We're down by 0.25% with an update on news worldwide with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Good morning. Revisiting the TikTok news we brought you just a few minutes ago, Oracle will recreate and provide security for the new U.S. version of TikTok's algorithm. According to a White House official, ByteDance would lease a copy of the algorithm to Oracle, which would then retrain from the ground up. ByteDance would not have access to information on TikTok's U.S. subscribers. President Donald Trump proclaimed Charlie Kirk a martyr for American freedom as he spoke at a memorial ceremony for the murdered conservative activist. Tens of thousands of people gathered for the event in a stadium in Arizona yesterday. Kirk's widow, Erica, also spoke, saying she forgives the man who killed her husband and saying she will work to continue Kirk's legacy. Australia, Canada and the United Kingdom have now formally recognised a Palestinian state. This ahead of the UN General Assembly meetings this week. Leaders of the three countries call it a coordinated push for a two-state solution. The move has drawn criticism from President Trump and Israeli Prime Minister Benjamin Netanyahu, who argue that it rewards Hamas and threatens Israel's security. And that's your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, sticker shock.
$100,000 a year for H-1B visas, and all of the big companies are on board.
We need workers, we need great workers, and this pretty much ensures that that's what's going to happen.
Up next, Haines of Pangaea, live from New York City this morning. Good morning. Brace yourself for Fed speak over the next 24 hours. Monday, Tuesday, Williams, Musalem, Hammock, Barkin, Myron, Bowman, Bostic, Powell. just ridiculous the next day or so.
I love the way you frame that. Brace yourself. It's going to be exciting. So do you think everyone gets up and just says, this is my dot and let me explain it? Or do you think they get up and they try to put some distance between themselves and the idea of a dovish or hawkish interpretation? At what point does this Fed speak matter, given the fact that people are already looking at 2026 and what could be, not what already is?
Things already seem incredibly divided on the committee. I imagine you'll see some of that through the next 24 hours. It might be more helpful if we knew whose dot was who, wouldn't it?
Yeah, the idea of who actually is going to be a voting member, who actually is going to still be there, how much they could potentially have clout on the committee. And then, of course, we get Fed Chair Jay Powell himself speaking tomorrow, and how much does he try to reclaim the helm of control over a committee that's divided?
Find out what he thinks personally in a personal speech. Let's see if there's any daylight between what he says over the next 24 hours and what we heard just last week. Going into that, equity futures on the S&P negative by 0.25% on the S&P 500. Another change at Goldman. And I say another change at Goldman because we've had so many in 2025. Before Friday, Goldman has changed their equity call for 2025 4 times. We've got a new 3-month price target, 6-month and 12-month price target. 3-month 6,800, 12-month is going to be 7,200, 6-month is 7K.
Everyone's struggled to keep up with a market that's hit record high after record high. How much is it marking to market as the market goes up and as you see resilient economic data, albeit with some softness, and a Fed clearly underwriting risk? And I think that was the big shift for a lot of people.
More on those calls from Goldman Sachs and David Costin later on in the program. Under surveillance this morning, down in D.C., sticker shock.
Train Americans, stop bringing in people to take our jobs. That's the policy here. $100,000 a year for H-1B visas, and all of the big companies are on board. No more will these big tech companies or other big companies train foreign workers.
We need workers, we need great workers, and this pretty much ensures that that's what's going to happen.
So here's the latest this morning. President Donald Trump overhauling the H-1B visa program, requiring a $100,000 fee for applications to limit overuse. Bloomberg's Tyler Kendall is back with us now for more. Now, Tyler, how is this actually going to work? 1, and 2, are they allowed to do exactly what they described over the weekend?
Yeah, hey, John, good morning. Well, you're alluding to 2 of the big questions here. 1, how is this actually going to work? And 2, the legal challenges that we're already seeing take place, including that many critics of this policy have pointed to the fact that the H-1B visa program was established by Congress, not the executive branch. So I would expect some legal challenges ahead. Now, this policy is really putting the mounting pressure on corporations, because we heard the U.S. Commerce Secretary go on in his remarks the other day in the Oval Office to say that this is going to be a decision that companies are forced to make, since they are typically the ones paying the fees associated with sponsoring applicants, though of course at a much lower price. The H-1B program makes 85,000 new visas available each year, and they go to workers with at least a college degree that go into these highly skilled professions. And we know that the majority of H-1B employers are those big tech companies like Microsoft and Amazon, which are already sounding the alarm over this policy and saying that it could hurt the U.S.'s competitive edge. But it really has been an issue that has long divided the Republican Party since President Trump took office. We've seen many in his base allege that these workers are taking American jobs, and they have pushed the president to change the process in a bid to try to help U.S. workers, and this idea that it's going to go into the U.S.'s push to help elevate them. Now, of course, important to keep in mind here that ultimately this policy did go into effect last night. So at the moment, John, it is on the books, though the White House did clarify to reporters that it does not impact those existing visa holders.
Tyler Kendall with the latest. Tyler, thank you. Appreciate it. To build on the story, Terry Haines of Pangaea Policy joins us now for more. Terry, welcome to the program. This is a quote from the president on the campaign trail last summer. What I will do, is you graduate from a college, I think you should get automatically, as part of your diploma, a green card to be able to stay in this country. How much daylight is there between what we were told on the campaign trail and how this is playing out in Washington?
I think there's a lot of improvisation going on here, John, frankly. Few people would dispute that the H-1B program is in need of serious overhauling. The president's action will be treated as a proposal by Congress, and I think probably gets stayed by the courts. The reason I say that comes down to what Tyler and Annmarie earlier had said about exactly how this program came to be anyway. My take for markets yesterday was that simply that there will be months of wrangling about this before a revised process will be decided upon, but this is not going to be an easy or quick path, number one. Number two, I don't know what companies Secretary Lutnick's been talking to. I assume just tech companies. But the fighter jets of lobbying got metaphorically scrambled over the weekend in Washington. And there's going to be a much longer fight over this than I think most people, maybe even people in the White House, imagine.
Well, when it comes to those tech companies, do you think behind the scenes they were given acknowledgement from the White House that they may be part of what the White House is calling in their fact sheet case-by-case exemptions for some companies and some workers?
Oh, I imagine so. Yeah, there's lots of signals going on here, but to me, this is all from a very familiar White House playbook. You kind of overreach and you just kind of set your mark out very cleanly, and then you cut back based on the kind of pushback you get. And so the case by case stuff was a clear signal to the tech folks that they're going to have the ability to kind of massage the system, if you will.
I was with the president months ago when he was on board Air Force One, came back to the press pool and showed us the gold card, was holding it up, saying it's going to be called a gold card, the Trump card. Why then announce in this abrupt fashion if they had months to then work with Congress to actually change the program and the law?
I'm on Team Lisa this morning on the timing, which I think has everything to do with the restart of U.S.-India trade negotiations and hopefully a successful conclusion from both sides' perspective, and very little else to do with anything else.
I'm just wondering, Terry, what do you think the U.S. wants from India during these trade negotiations? How do you think this is actually going to evolve in a way that could be palatable for both sides?
The bottom lines change over months. I mean, let's remember this process has been going on for some 6 months or so. The bottom lines change on exactly what the United States wants, but what the United States has wanted consistently is a much more incremental sort of deal, the kind of phase one, phase two, phase three sorts of deals we're seeing elsewhere than India wanted. India's original timeline was something on the order of, we'll get a very large tranche of issues resolved in July, second tranche in October. Obviously, that timetable's out the window. But fundamentally, what the United States wants here is what they want everywhere else, which is they want lower tariffs and they want greater trade access. And India, for a variety of reasons, agriculture, business, lots of other things, has not been willing to kind of take the chunks that the United States offers, and that's been the substantive barriers that have prevented a broader trade deal.
Terry, appreciate your time, sir, as always. Thanks for weighing in. Terry Haines of Pangaea Policy. I wonder also if there's some countries out there looking to make moves of their own to try and attract some of the talent that would otherwise have moved across the border to the United States.
Yeah, we've already seen that in academia with the likes of Oxford and Cambridge saying, okay, if you're a disgruntled professor over in the United States, guess what? We're hiring. And you wonder how much this really feeds into making a push for technological prowess. Again, this idea of competition. How much is it competition for talent as much as it's competition for technology?
I think you'd be very upset if you were an engineer looking at the difference between Silicon Valley salaries and the salary that you could get in the United Kingdom. If I was going to take a stab at things, I would say it'd probably be 50% less in the UK. That would just be a guess, but I imagine I'm pretty close.
Which is the reason why so many people come to the United States, and that's the reason why people have been enrolled in school to try to get that H-1B visa when they graduate after being trained in this country. And now there's a real question of how much those plans truly are disrupted.
Let's see how this actually plays out in Washington. This one's slowly coming together over the weekend, and we'll see how quickly things get slapped back down. Coming up on the programme, we'll catch up with Angelo Zino of CFRA as Oracle lands TikTok's US algorithm. Plus, Danny Berger joins us with your morning movers, the maker of Tylenol, taking a hit on news out of Washington. The stock is down by more than 3%. This from Max Kettner of HSBC this morning. The title of his note, Up, Up and Up More. Goes on to say this. There's more to come that should drive risk assets higher still. Re-accelerating data and Fed rate cuts make for a powerful mix and argue for a more cyclical stance in equities.
Look, they're not alone, right? This is what everyone believes, which is the reason why I saw another upgrade from Goldman Sachs. The idea that we are talking about a K-shaped recovery, a K-shaped economy. He said they don't view it as a risk. It's something that makes us even more bullish. So there you go from Max Kettner over at HSBC.
Treasury yields have a long way to rise until they will hit risk asset valuations. OK, equities right now down by about 0.25% on the S&P. We're down by a quarter also on the Nasdaq, off the back of a 3-week run of gains on both the S&P 500 and the Nasdaq 100. In the bond market, Treasury yields look like this. Yields just about unchanged. 2s around 360, 10s around 413. With the latest morning movers with your single names, here's Danny Berger for more. Hey, Danny.
Hey, John, starting with that breaking news we got about 30 minutes ago, and that is more on the contours of this TikTok deal. Part of it is about the role that Oracle will be playing, that they will be recreating the TikTok algorithm and providing the security. We also learned from President Trump speaking on Fox News that the Murdochs, specifically Robert and Lachlan, would be playing some sort of role in this TikTok deal. So as part of that, you can also see Fox shares are rising about 2.7% this morning. In other news coming out of Washington, D.C., the Washington Post reporting that the White House plans to link one of the key ingredients of Tylenol to autism, a highly controversial thing to do. And the maker of Kenvue, the maker of Tylenol, I should say, Kenvue, highly disputes that, but telling Bloomberg News that there's no evidence of that. Even so, those shares falling some 4%. Finally, elsewhere in pharma, Pfizer buying Metsera for a $7.3 billion deal. It is the maker of an obesity drug. Pfizer, for its part, has tried to produce its own obesity drug, and it has not gone to plan. The key for this drug, though, is it would allow users to only take a once monthly shot instead of weekly, so it's more attractive because of that. So the takeover target goes up nearly 50%, while Pfizer rises 1.7%. John.
Danny, thanks for the update. Appreciate it. More from Danny in the next hour. On our radar this morning, the White House says Oracle will recreate and provide security for a new US version of TikTok's algorithm, a key step in a deal to sell the app to American investors. Elsewhere, President Donald Trump upping the price for an H-1B visa application, now requiring a $100,000 fee. The move rattling companies, particularly in tech, that depend on the program to recruit employees. And finally, South Korea's president is warning that accepting US trade demands could trigger a financial crisis. The two nations have stalled on a deal where South Korea would invest $350 billion in exchange for lower tariffs.
It only has foreign currency reserves of about $416 billion. So this is almost the entirety of their foreign currency reserves. They've talked about some sort of foreign exchange swap to get the swap line with the United States in order to be able to effectuate this. But it highlights the details, and it's something that you've talked a lot about, John, the details of all of these investment plans and how little is actually known about how easily it'll be for some of these companies to, for some of these countries to execute.
South Korea wants a safeguard. In order to do this, they want to make sure that they agree on this currency swap and able to ensure that they could then withdraw the $350 billion. I thought this part of the interview was really interesting. When asked if they would walk away from the deal, this was the quote. "I believe that between blood allies, we will be able to maintain the minimum amount of rationality. It's UN General Assembly week. We do know that top South Korea diplomat will be meeting with the Japanese diplomat and, of course, the U.S. diplomat. So potentially the story will move forward this week in New York."
There's been some complications around these deals, particularly the working arrangements of some of the individuals that need to come over here and help them build out some of these investments. And South Korea is at the epicenter of that, not just Japan.
Absolutely, especially when what happened as of recently at the Hyundai plant. And the president of South Korea was saying, I think this was an error. And right now they want to move past that episode and they really want to get to a trade framework. And it sounds like when it comes to trade framework, they really need to make sure they have safeguards when it comes to the currency swap.
Watch this space. There's going to be a lot of diplomacy carried out this week here in New York City. Let's turn to our top story. Oracle securing a deal to recreate TikTok's algorithm for a US version of the app in a White House-backed deal. President Donald Trump name-dropping reported investors.
I hate to tell you this, but a man named Lachlan is involved. It's a very unusual name, Lachlan Murdoch. And Rupert is probably going to be in the group, a couple of others. So I think they're going to do a really good job.
Angelo Zino of CFRA writing, concerns remain, execution issues tied to moving all users to a new app. And then will TikTok America have the ability to run the platform the same way? Angelo joins us now for more. Angelo, we've got a few more details since we last spoke. Have you got a clearer picture of just how this is going to work?
Yeah, I mean, John, I'd say to your point, we have gotten more details, and I mean, we have a better understanding at this point. I mean, the fact that I think there was some debate out there whether or not this was going to be kind of this duplicated algorithm out there that's going to be run by, Oracle and this, new group of investors, or was it going to be some sort of licensing deal with ByteDance? We now know it's going to be, this U.S. consortium, this new TikTok America essentially owning the actual algorithm. And that's kind of what we expected was going to happen in order to actually kind of lift this actual TikTok ban that we've seen here. So, the way it's playing out is the way we thought it was playing out. We've also got details in the sense that there's going to be 6 out of 7 board members that are going to be Americans. Who exactly that's going to be at this point in time also remains unknown. But ultimately, it's playing out the way we thought, and we continue to have our concerns. But nonetheless, TikTok remains a great asset, and I think ultimately, the individuals or the consortium of investors that are acquiring, the asset, will probably benefit here long term.
Angelo, based on how the market's trading, how certain is this deal to get through, at least in the eyes of equity investors?
I mean, listen, the administration said that it's a done deal over the weekend, right? I mean, we don't necessarily believe that until, everything's kind of signed and done. I wouldn't necessarily say this is a done deal. So, I think it continues to be highly contingent upon how trade negotiations go here over the next couple of months. I think, I feel fairly confident that, hopefully the December pushed out timeframe will be the last time we have to push this thing out. But nonetheless, I mean, this is one of those situations where, it's never a done deal until it's done.
Does this help the likes of Meta or Facebook as well as Google and YouTube, or does this hurt them? The idea that you do have a definitive presence of TikTok, but with the algorithm run from someone else?
I think it helps them personally. So I think it actually, I think it potentially, puts, if you think about how much the social media landscape has changed over the last 5 years, I mean, just take a look at, Meta themselves. I mean, Reels, popped up only 5 years ago. It actually didn't, on Instagram, didn't show up on Facebook, I think, until, mid-late 2021, and didn't actually go worldwide until early 2022. So when you kind of think about how much the world has just changed over the last couple of years, how much the competitive landscape has changed over the last couple of years, and now we're kind of, embarking into a new AI environment, who has control of these algorithms, and how they handle this algorithm and the platform, over the next couple of years is going to mean so much. And I have a lot more confidence in a guy like Zuckerberg, who's going to be able to maybe potentially take advantage of a situation where, whoever is running TikTok America may not be as sophisticated as those ByteDance engineers out there.
Well, will it be successful without ByteDance engineers?
Well, it depends on who is coming in to kind of help this, consortium or, TikTok America to really kind of run this whole thing up. I mean, if you were to ask me, does Oracle have the ability to do it themselves? I couldn't necessarily give you an answer on that. Again, it would all be dependent on who exactly they bring in to really kind of, help, progress TikTok America in the future. But again, it all remains unknown at this time, point in time. And, at least in the near to intermediate term, it is a risk, right? Especially when you start thinking about the fact that, hey, listen, you do need to bring all these users onto a new app. So again, there's a lot of moving parts involved with all this, which is, again, why we have more confidence, in a Zuckerberg, in a Meta, to potentially, take advantage of a situation like this.
Are you basically saying that Meta is on par with ByteDance's engineering expertise?
I would say they're probably on par, even ahead of potentially a new TikTok America that would be run by, that wouldn't be run by, these ByteDance engineers.
Angelo, just a final question. The White House has got a taste for intervention, clearly playing a major role in the brokering of any potential deal between the US and China and every individual that's involved in this agreement. How keen an interest are they going to take in this company after things have closed? How much of a role will they play on what is playing out on that platform?
Yeah, I mean, and maybe one thing that is different than what maybe I previously thought. I thought maybe they would have taken a stake in this. Maybe it looks like at this point in time, the administration is more looking to take a multi-billion-dollar fee from this transaction. But nonetheless, I think they're definitely going to have their eyes set on how TikTok America does and make sure that it does perform well here in the foreseeable future. But if they're not necessarily taking an ownership stake, maybe it's not as imperative as kind of what we're seeing from potentially an Intel stake at this moment in time, but remains to be seen.
Angelo, thank you, sir. Appreciate it. Angelo Zino of CFRA. A few more details. Still a lot of unanswered questions.
Your question's a good one, not just with respect to the monetary influence of TikTok going forward, but the actual algorithm going forward and just how some of the stories are ranked and the posts really get distributed. That remains an open question. What is a more American version of that algorithm?
I think they're going to have an ongoing interest in the content. Let's put it that way. I don't think that's going away.
We've seen this consistently, that the person who controls the algorithm controls the way people get their news, period, full stop.
As we get more details on that story, we'll bring them to you. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's bring in Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump says a U.S. government shutdown is likely, citing a stalemate between his party and the Democrats. Senate Democrats and Republicans each blocked the other party's rival plans to provide temporary funding, moving closer to a shutdown October 1st. Senate Democratic leader Chuck Schumer is urging President Trump to negotiate. Kim Jong-un says he'd be open to talks with President Trump when he travels to South Korea next month. North Korea's leader says he has, quote, good memories of President Trump and sees no reason not to meet him again as long as the U.S. stops insisting on the dismantling of his country's nuclear arsenal. The Trump administration is getting ready to announce a link between Tylenol and autism. The Washington Post is reporting that officials have been reviewing research that suggests a possible link between the use of Tylenol early in pregnancy and an increased risk of autism in children. And that is your Bloomberg Brief. John.
Vonnie, thank you. Appreciate it. Up next on the programme, a divided Fed.
The committee's also spooked a little bit by last year, because last year the data looked weak but then turned around abruptly. It's hard to say exactly how high the bar is. That's a judgment call that'll have to be made by members of the committee.
Up next, Krishna Guha of Evercore ISI, live from New York City. You're watching Bloomberg TV. Live from New York City, welcome to the program. Equity futures just a little bit softer. We're down by 0.3% on the S&P. Likewise on the Nasdaq, the Russell, coming off the back of the longest weekly run going back to 2020. It's been some 5 years that we've had a stretch of gains like this on a weekly basis for the Russell 2000, 7 consecutive. In the bond market, 2-year, 10-year, 30-year bond yield shaping up as follows. The 2s and 10s pretty much unchanged so far this morning. Bond yields at the front end of the curve at 357, on 10s around 413. A little bit light on data through the week. Look out for PMIs to see if we see any sign of a re-acceleration in economic activity coming into September. This came from Mike Schumacher of Wells Fargo. Markets appear to have priced the cutting cycle to perfection. The Fed's unchanged outlook on growth and labour, alongside an upward revision to core inflation, creates tension with current pricing.
So this, to me, is the biggest question. Can we see the ongoing flattening in the yield curve that we've seen? Or, say, on Thursday, when we get $44 billion of 7-year notes that are being sold, do you get some sort of pushback of this idea that you can perfectly situate a Fed policy with a reaccelerating economy without getting the commensurate inflation that would cause long-term yields to rise?
At least over the last few weeks, we've rejected that story, haven't we? That doom and gloom about the supply side stuff. We've rejected that, and I wonder if it comes back on the table too.
I think that to me is the big test of this week, considering that it is light in data. We're going to be trying to dodge traffic for Ingka, and I'm going to be watching the $44 billion of 7-year note auctions.
We're going to be walking a lot,
yeah.
I think is what's going to be happening this week. Yeah, that too, and walking. Yields right now on a 2-year, 357, on 10s, around 413. Under surveillance this morning, a divided Fed.
The committee's also spooked a little bit by last year, because last year the data looked weak but then turned around abruptly. It's hard to say exactly how high the bar is. That's a judgment call that'll have to be made by members of the committee. You've got markets pricing probably 75 by the end of the year. That would be a significant move by the end of the year, and they have a little bit of optionality.
So here's the latest this morning. Divisions on the Federal Reserve clouding the Fed's communication as Fed Chair Jay Powell is set to speak tomorrow. Krishna Guha of Evercore ISI writing, the active debate for policy going forward will be predominantly within the 12 who see more cuts in 25, not the 7 who do not. Krishna joins us now for more. Krishna, welcome to the programme. Let's just start with that division of the Federal Reserve. Just how material is it and how different is it to what we've seen in years gone by?
So I think we learned two things at the meeting just gone. First, that this is still Powell's committee. He can still muster majority support, particularly, although not disclosed, among the voting members, if you guesstimate whose dots are whose, for the policy path that he prefers. And that's market risk friendly because Powell is on the more dovish side of the committee, the more preemptive risk management side. But there is this large block, 7 Fed officials, who don't see any further cuts after the September cut this year. So the question is, what influence will that 7 have on the debate? My sense is not that much. I think the debate will mostly be among those who see the need likely to cut rates further, but will be debating exactly the economic conditionality and cadence rather than that block of hawks. But you can't completely dismiss the 7 no-cutters.
Krishna, when you started talking about the Federal Reserve, you pointed out that this was Chairman Powell's Federal Reserve, almost like it was his committee. Is it too early to begin pricing a post-Powell Fed?
So I think the market, sensibly in my view, is looking at 2 different time horizons in a different way, right? Through the end of this year, indeed even through really at the end of Q1, early Q2 to the very end of Powell's term, I think Chair Powell will continue to drive the committee. I think there is a lot of loyalty to Powell. And I think that the divisions among the central group, while they're there for sure and amplified by these political strains, I don't think they're very, very deep. I think most of that core group would agree with Powell that you want to be stepping rates back to a more neutral setting, and that if the Labour side continues to look quite weak, you want to do that in a timely manner. So that's the successive September, October, December cuts versus perhaps if the data were to pick up, then you might slow down that process. Separately, the market needs to look forward through the end of next year and beyond and ask what might change under new leadership. And I think when you look at the market pricing through the end of next year, you very clearly put some weight on the prospect of a more dovish shift in the Fed reaction function as new leadership takes over.
Krishna, has this market adequately appreciated just how dovish this central bank already has been? The idea that they're cutting at the most aggressive pace going back to the 1980s when we weren't in recession. I mean, this is really an unusual type of paradigm given that inflation has remained above the 2% target for more than 4 years and is expected to remain above that for the remaining upcoming 2 years. I mean, at what point is this market not appreciating how hot this Fed is already running the economy?
So I certainly agree with you that this is a quite unusual set of circumstances. I think it's important to caveat that in 2 ways. First, the Fed is not cutting rates to, at least under Powell, is not contemplating cutting rates to what the Fed at least would consider stimulative territory. What they're talking about is removing what they estimate to be the remaining restraint in the economy. That's the roughly 75 basis points of restraint between where we were on the eve of the September meeting and a spot neutral setting that might be in the zip code of 3.5, 3 3/4, separate from where the long-term neutral rate might lie when things settle down to equilibrium, which many still see at the Fed as more like 3%. So you're talking about removing restraint, not providing stimulus. The other thing is, of course, you're seeing, I think, under Powell's leadership, and of course with pressure, intellectual pressure from Waller and 1 or 2 others, The Fed's taking a view that maybe they should be, at least to some significant degree, looking through that current elevated inflation, because it's to a large extent reflecting the pass-through of tariffs into prices. And of course, from a textbook sense at least, you want to look through that first round mechanical tax impact, if you like. It's a bit like a sales tax in that regard. And you want to be focused on where you think the underlying inflation dynamics are going, what risk there is of inflation persistence. And, if you look at wages minus productivity, if you look at a lot of the services, particularly the more market-based services, you look at expectations, the news on that second round inflation dynamic is reasonably constructive. But I certainly still take your point that the Fed is cutting on risk management grounds into what may be the early stages of a cyclical reacceleration. I think the market is going to want to see more evidence on that firming in activity, and if it's passing on to a firming in the labor side too, before it really starts to trade that. But if you were to see that, then I think at a minimum, people would start to pay more attention, not just to these 3 cuts, but the prospect that when the next chair picks up the cutting baton, we might well be in danger of overdoing it.
Let's say the Fed cuts rates and long-term rates also decline. Will that help housing affordability? Will that help with this sort of declining trend in inflation that has hinged to the housing market, frankly, which has kind of gotten slack?
Well, so certainly I think if longer term rates were to come down from here in an appreciable way, then obviously that would lower, the classic 30-year fixed type financing costs. And that would certainly help buyers at the margin. It might actually work a little bit more on price than on quantity in a number of cases, but certainly it would be good for housing stocks. I think in the absence of that, what we're likely to see is more people moving to fund at the front end through ARMs, because of course, as the front end rates, the Fed sensitive rates do come down, there's an opportunity potentially to finance at the front end rather than finance through the classic 30-year. I don't think that there is a huge amount of scope for 10-year yields to come down further from here if we are indeed in the early stages of at least cyclical stabilization and possibly even cyclical reacceleration. My hunch is if that's the path we're on, then the 10-year yield will be higher 6 to 12 months from now, not lower. And with it, of course, then those conforming loan rates. With respect to housing and inflation, I get the point you make, and it's a subtle one about the relationship between, home construction and ultimately, OER, rent, and those other housing services related components on inflation. I think that's right. I still think overall, though, higher longer term interest rates will tend to restrict the economy in aggregate across all the sectors and put downward pressure on inflation, and vice versa if the 10-year goes down.
Krishna, appreciate your time. Giving us a lot to think about. Thank you, sir. Krishna Guha there of Evercore ISI. 2 different time horizons. This until the end of, say, Powell's term, then everything after that. Peter Shea of Academy just moments ago. We still believe the market is underpricing the number of cuts, the speed of cuts, and the efforts the administration will take to keep yields lower across the curve. We'll pick up on that note in just a moment. Up next, Wei Li of BlackRock, Henrietta Treyz of Veda Partners, the former White House trade official Kate Kalutkiewicz, and Kelsey Berro of JP Morgan Asset Management. The second hour of Bloomberg Surveillance is just around the corner.
The Fed's outlook has really shifted.
They're going to look through temporary tariff effects.
Cutting rates is not going to help on the inflation side.
The uncertainty, rather than the level of tariffs, is going to be a challenge.
There's a little bit of push-pull in almost everything you look at.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this on the S&P 500, pulling back from all-time highs by about 1/3% on the S&P. On the Nasdaq 100, down by 0.4. In the bond market, some stability across the curve. Twos down by almost a basis point, just about unchanged on 10s at 412. If you're confused by the Fed speak of the last week or so, prepare to be even more confused. There is a ton of Fed speak coming up over the next few days, including Chairman Powell himself tomorrow morning.
Yeah, today we've got Fed's John Williams, Musalem, Hammock, Myron, and Barkin. Myron will be giving his first speech at the New York Economic Club today as the governor on the Federal Reserve. Powell, Bowman, Bostic, I mean, all of these lining up. And a real question here, what insight will they actually give us? We know that this is a divided Fed. How do you take signal from noise at a time where this is incredibly noisy? And this might be Jay Powell's Fed now, but come next year, whose Federal Reserve is this going to be, and exactly how will that get manipulated?
Well, it might be Stephen Myron's, given the fact that we know that he wanted a deeper rate cut for September. I think he might struggle with why you should have a deeper rate cut if he actually thinks the economy is booming, what the president wants to hear. And when it comes to current Fed Chair Jay Powell, we know that his chairmanship is over next year. We still are waiting for clarity from Jay Powell whether or not he's going to stick around as a governor for 2028 and what that could mean potentially if he lingers around when it comes to the FOMC.
Fed Governor Stephen Myron might be a taste of things to come, which is why it's important to look out for what he's got to say later on this afternoon. I mentioned this note from Peter Chia of Academy in the previous hour. Worth picking it up again. We believe the market is underpricing the number of cuts, the speed of cuts, and the efforts the administration will take to keep yields lower across the curve.
How do you say yield curve control without saying yield curve control? And that is the way that you do it. This is what a lot of people have been speculating with respect to why you have seen such a controlled long end of the yield curve, why you haven't seen a steepening in the yield curve on the heels of a pretty dovish Federal Reserve. Yes, maybe not as dovish as people expected, but nobody's listening to what they actually said and just looking at what they think they'll probably do. So this raises a question. Can this Fed meet the moment, and what will it take for them to do so, given some pretty high expectations already baked into the market?
I have to say, I would have thought that by now we'd have a decent idea over who the next Fed chair would be. This has taken a little bit longer, this process, than I thought it would.
It is taking a little bit longer, but we know the Treasury Secretary is sitting down. He's having these meetings, but I think they need to decide with Stephen Myron first. Does he stay on or not? And then do they elevate someone from within, or do they really want someone from the outside?
The longer this takes, the better it is, because they can just keep talking about too late Fed Chair Jay Powell, and he's a great scapegoat. So I think this is actually by design.
And he's cutting rates anyway.
Exactly.
So you get the best of both worlds, at the moment at least. Coming up this hour, we'll catch up with Wei Li of BlackRock. With Wall Street riding high, we'll speak to Henrietta Treyz of Veda Partners on a big shake-up for the H-1B visa program. And we'll speak to the former White House trade official, Kalutkiewicz, with US lawmakers taking a rare trip to China. We begin this hour with stocks holding near all-time highs, driven by big tech and AI. Wei Li of BlackRock writing, the AI theme keeps driving US equity performance. We think elevated valuations can be justified if they keep delivering on expected 15 to 20% future earnings growth. Wei joins us now for more. Wei Li, good morning. Good to see you. You've been risk on with the team since, I believe, April. Is that right? What's anchored that view?
What's
anchored that view?
What's anchored that view? Well, it's a strange time to go risk on back in April, if you remember, because back then the big questions that people are asking themselves is this the end of U.S. exceptionalism? Is this the time that the dollar may lose its reserve currency status? So to lean against prevalent market questions and really go risk on despite peak policy uncertainty was hard. But what really anchored that view is really our appreciation for the fact that there are certain things that are so fundamental to the working of the economy and markets that they cannot change quickly. Markets were pricing for them to change quickly, so we would lean against that. So in BlackRock, we call this fundamental things the immutable laws. I don't know if that has caught on outside of BlackRock, but the idea that certain things, markets may price them to change quickly, but in reality, the facts on the ground are that they cannot, is really what is behind our risk on view since April.
In the middle of September, the market's in a different place compared to where we were in April. You were leaning against where the market was at the time. Now equities are at all-time highs. Credit spreads are super tight. Now, it's not payrolls. That hasn't driven a reduction in your risk posture. What would lead to a change in your risk posture at the moment?
Well, right now we're in a bit of a sweet spot right now because the Fed has macro cover to start the series of rate cuts. And because payroll is so weak to justify that, it doesn't have to be a big political debate right now. And this is really a sweet spot because the cuts have been priced in. U.S. growth is not really that bad, right? We're looking at 1.5% for this year growth. It's not, shooting the lights out, but it's still very far away from recession. You look at earnings, it's very strong, especially in the U.S. equity market, especially in the tech and AI plus complex. So when you bring all of this together, you kind of have the benefits of Fed cuts without the penalty at this juncture, and on top of that, fundamental picture is holding up, which is why we continue to like equity market at this juncture. And then our study shows that 15 to 20% earnings for U.S. tech will be enough to support current multiples of U.S. tech 30 times plus. And we look back in history, the last 30 years or so, a quarter of those periods actually has seen U.S. tech growing earnings in that range. So, it's doable, and it's happening right now.
So do you just ignore H-1B, ignore the idea of U.S.-China trade discussions, ignore all the geopolitics that directly affect all of these tech companies? Is it all sort of negligible because of the immutable laws that essentially these two economies cannot decouple that quickly? And so essentially there will be a level of status quo that will just continue?
I think ignore is a big word. I don't think we can ever ignore big headlines like that, but we do want to kind of understand the market dislocations driven by such headlines and try to understand how much of them can actually play out over the near term versus how much of them cannot change over the near term. So you talked about US-China trade relationship, like back in April, we're talking about closing trade deficit, but the facts on the ground is that the global supply chain is so intertwined that you cannot change things very quickly. So I think that very much speaks to how markets are making new highs, both in the US but also in China's sphere of influence. You look at Hang Seng Tech, it's up 40% on the year. You look at Hang Seng Healthcare, it's up more than 100% on the year. So really selective opportunities across the board against the backdrop of a somewhat weaker dollar.
How do you know if we're creating a bubble? And I ask this because Dan Greenhouse said every new high in the bull market should be bought except the last one, and all that you need to know as an investor is why it's the last one. And that's essentially where people are at, which is if it's a bubble, that's not a bad thing. Keep buying. But it just means you probably are going up until it goes down. Do you feel like that's the case?
Well, I don't think we can say that we know we're not creating a bubble. I think what we are seeing right now is that we're seeing companies really spending and overspending in the AI race to really stay on the table, to really stay in the race. So I think it's possible that we're going to see more overspend in the near term because it is really existential. So one of the things that we're keeping a very close eye on, specifically with regards to the AI build out and tech, is return on investment for the capex that is being spent, especially as you think about companies kind of outside tech spending more in AI. We're going from capital light to capital intensive sectors kind of being very integrated and really thinking about it, and that has significant implication on return on equities too. So this is one signal that we pay close attention to understand if there is further momentum. Another signal is credit spread. It's very tight right now, but typically credit spread tends to kind of increase quite a bit before major equity market corrections. So right now we're paying close attention to both the credit spread, but also specifically the relative credit spread of tech space versus broader IG. They are very tight right now, so not showing significant stress, but that's something that I monitor daily.
When you look at the AI overspend, and this was really on display last week when I was with the president, tens of billions of dollars allocated to the United Kingdom. A lot of that has been also allocated to the U.S. How long can that persist, the overspend?
Well, if we look at the percentage of spend over free cash flow, it's higher than before, but it's not super stretched. So companies can still spend for now, hyperscalers can still spend for now, and also they can go into funding market, private market, for example, to get additional cash to spend. So there has been an increase, but in our view, is not getting to a point where this is too much and we gotta kind of think about putting a stop to it. So we're paying very close attention to free cash flow to understand if they actually have the wallet to do so. But right now, it's all hands go.
Are you monitoring potential energy constraints off the back of these investments? Do we have the power? Do we have the energy infrastructure?
That's a very big question, because energy constraint may well be some of the kind of not bottlenecks, but certainly factors that can slow down the AI build out, because it's also happening in the context of the low carbon transition. So far this year, if you look at electricity inflation in the retail space in the US, we're talking about 6% year on year. So we're definitely seeing greater pricing pressure coming through because of the energy demand and versus the supply picture. So that's something that we monitor, and it actually may impact the broader inflationary mix that the Fed is going to have to respond to. So whilst right now we think that there is room to lean into duration, to lock in attractive yields at these levels, real yields in particular, over the longer term, we still think that the inflationary pressure hasn't gone away. The trade-off between inflation and fiscal spend and debt servicing costs, that tough tension hasn't gone away. So over the longer term, steepening view is still our core view. But for now, given the Fed cycle, we want to lean into that.
Okay. Look, there's a great market story here. Fantastic for the economy. But I think we should detail the political fallback that we could see and what it could mean for society. The energy intensiveness of that growth that we could see over the next several years off the back of this story is potentially going to cause problems politically and societally over the next several years or so. And I think you're already seeing signs of it. The energy price pickup, that story is already starting to build.
Yeah, especially in the United Kingdom and in other places as well. But this idea of if people are paying their Con Ed bills every month and it's getting to be bigger and bigger and bigger, suddenly people are going to start to say, wait a second, why is this not rebounding onto us? But everything's turning into a political story.
Well, it's good to see you. Thanks for dropping by. Wei Li of BlackRock, thank you very much. If you're just joining us, equities down by about 1/3% on the S&P, with an update on stories worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. T-Mobile is announcing a shake-up in its leadership. CEO Mike Sievert is stepping down from the role and will move to vice chairman, with current COO Srini Gopalan setting to become the next chief executive. Those changes are set to go into effect November 1st. Both Sievert and Gopalan will join Bloomberg Tech tomorrow at 11 Eastern. A final deal on TikTok is expected to be signed in the coming days. U.S. operations of the app's algorithm will be secured by Oracle once it's spun off from its Chinese ownership. According to the White House, Americans will hold 6 out of 7 board seats for TikTok. Hong Kong International Airport expects to cut flights starting Tuesday as it braces for one of its strongest typhoons in years. Sources telling us here at Bloomberg, all flights will be stopped from 6 p.m. local time through 6 a.m. on Thursday as Super Typhoon Ragasa bears down. Hong Kong was last battered by a super typhoon in September of 2023. That halted flights for 20 hours. And that is your Bloomberg brief. John.
Vonnie, thank you. Appreciate the update. More from Vonnie in about 30 minutes' time. I'm next on the programme, upping the barrier to entry.
$100,000 a year for H-1B visas, and all of the big companies are on board.
We need workers, we need great workers, and this pretty much ensures that that's what's going to happen.
A conversation up next with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. Bullish feel in the air, let's put it that way. This from Julian Emmanuel of Evercore just last week. He said nowhere to go but up. And then we had this from Max Kettner of HSBC a little bit earlier this morning. The title of his note, up and up more.
Essentially, if you have an economy that's doing okay, even with rates where they are, and you have this super cycle of investment overlaid on top of it, and then you get rate cuts, well, everyone gets bullish. What is the potential stop to that? If everyone is bullish, at what point do some people start getting nervous?
We've set a series of all-time highs. If this is nervousness, this ain't much. We're down 1/3% on the S&P. On the Nasdaq, we're down by 0.35. Under surveillance this morning, upping the barrier to entry.
Train Americans, stop bringing in people to take our jobs. That's the policy here. $100,000 a year for H-1B visas, and all of the big companies are on board. No more will these big tech companies or other big companies train foreign workers.
We need workers, we need great workers, and this pretty much ensures that that's what's going to happen.
So here's the latest this morning. President Donald Trump signing a proclamation requiring a $100,000 fee for H-1B visa applications to curb overuse. Joining us now to discuss is Bloomberg's Tyler Kendall. Tyler, the Commerce Secretary, Howard Lutnick, said $100,000 a year. Have we clarified that now? Is it a year or per application?
So, John, as of now, our understanding is it is per application. This was part of the White House's bid to clarify the policy, also making sure to say that this does not extend to existing visa holders, appearing to be a bid to calm some of these anxieties that we heard immediately from these companies after Howard Lutnick said that it's ultimately going to be up to corporations to make these decisions, considering they're the ones that typically front the fees associated with sponsoring applicants, though, of course, at a much lower rate. Now, the H-1B visa program opens up 85,000 new visas per year for those workers that are highly skilled, have at least a college degree, and go into these in high-demand professions. And we know that the bulk of H-1B employers are those big tech companies like Amazon and Microsoft, who are already sounding the alarm that this could hurt U.S. competitiveness, not to mention that we heard from critics of this policy to expect legal challenges since the U.S. Congress has set clear requirements for how U.S. businesses petition for foreign workers, really setting us up. We're expecting for another legal test here when it comes to how the administration is using executive power. And John, while this issue has really long divided the Republican Party, we saw some pressure mounting from President Trump's own base that alleged that this policy takes away jobs from American workers. It's also worth pointing out the timing here that we know that the bulk of H-1B visa holders come from India, and the trading partner has long seen their negotiations for a trade deal stalled. But today there is a delegation arriving from India to Washington to continue those negotiations, and this no doubt was unwelcome news.
Tyler Kendall with the latest. Tyler, thank you. To extend the conversation, Henrietta Treyz of Veda Partners. Henrietta, welcome to the programme. Many people have long talked about the problems with this programme and the abuse of it. This is a problem. What do you make of the remedy?
Well, I think it's very interesting as a former tax staffer and somebody who has worked in both the House and the Senate. What's happening here is that the president is yet again taking away the power of decision making over taxation, just like happened with tariffs, and is putting it squarely in the administration's hands. So as Tyler was just pointing out, this is absolutely going to run into lawsuits and is going to be a problem for lawmakers who are going to have to assess whether or not this is something that they want to carry forward. But in the absence of immigration policy, which we are plainly not able to get out of the House and Senate, I think it really shines a spotlight on how dysfunctional they've become, which obviously we'll see if we shut the government down as well.
Well, what Trump is doing on the executive branch, will it force his colleagues in Congress, the Republican Party, to take up some new legislation about these visa fees?
That's an interesting question. I doubt it in the near term. I mean, they're nowhere on being able to legislate immigration policy, which is invariably what this becomes a part of. But it has had, as you pointed out, bipartisan opposition over, decades. I remember the 2013 debate had a big, huge fraction of it was about H-1B visas. So the president is basically saying, if Congress is not going to act, I'm going to. And that's what we're seeing. What's interesting here is that the president is obviously prioritizing tech, whether that's bringing all the tech titans to England to be at Windsor Castle, or whether it's to tackle H-1B visas, to talk about the oracles of the world with TikTok. And what's interesting to me is that we are not seeing a similar rollout on the rest of the U.S. economy, and in particular, the industries that are being most harmed by tariffs. So whether it's the manufacturing sector, which has lost almost exactly the same number of jobs as this H-1B visa issue will imperil, as well as the agriculture sector. So I think there's a whole segment of the U.S. economy that's being left out of these discussions. And the tariffs with India, which I think you can basically add this onto, is going to be a big part of the debate.
Well, Henrietta, if Congress is not going to want to take up the visa fees, and they're the ones that have jurisdiction over it, is this basically null and void? Is this even going to happen, these $100,000 visa fees?
I mean, certainly not if they go to the courts, and it's really just a matter of time before we see how long this is going to be into effect. Obviously, there's a lot of confusion, as John just pointed out, between, how is this going to be applied? Is it an annual thing, which Secretary Lutnick reiterated repeatedly in the White House, in the Oval Office, and then has since walked back. There are going to be licenses, I would imagine, and exclusions. And so that's going to be something that those closest to the administration are able to finagle. And we'll see if JP Morgan does it better than Oracle.
Right now, Henrietta, it seems like the market's numb to pretty much all of the very loud headlines that everyone shrugs off as being initial opening arguments, and then will get watered down. I just wonder, in the roulette of topics in Washington, D.C., how much the people you speak to are aware of the fact that the government is going to shut down, almost certainly that everyone's talking about this, and that there could be potentially market ramifications?
Yeah, it takes a while to get to the market ramifications, but you make a really good point here, which is that the main topic of discussion in, the streets of the United States, as well as on Capitol Hill, is really the cost of living. And when you have 83% of Americans saying that high prices are their number one priority, which is the poll that just came out over the weekend, you're seeing a material disconnect. This H-1B visa thing is not going to do anything for them. Keeping tariffs on India at 50% rates is not helping. So there's actually these bubblings of working groups that are happening on the House and the Senate side to take down the Brazil tariffs that are at 50%, to start a working group to talk about the president's authority to randomly impose these IEEPA tariffs across all nations and all kinds of goods, to have them rein in some of their power again. It's very much at the beginning stages, and I wouldn't take any of this seriously yet. But as we get into the midterm election cycle, members are going to have to talk about this, because the tariffs are the number one concern of a lot of Americans who are dealing with higher prices at the grocery store and at, Walmart.
This is an important point, Henrietta, the idea of how to view the lens of the just incredible funnel of news that keeps getting funneled at us every single day from Washington, D.C. How much is the incoming midterm elections shaping some of what we're hearing about? The idea of what initiatives are making it to the front lines, the idea of a government shutdown. I mean, essentially, are we playing the blame game here? Are there going to be tangible ways to bring down the cost of living heading into the midterm elections? Or is this essentially a jostling for the upper hand in the media sphere?
I mean, man, you take the tariffs off, that's what, $2,600 per family, per household annually. So, I mean, you could do this pretty quickly if you wanted to. I think the tariffs are going to be a major topic of the midterms, and the members are, pushing that as far away as they possibly can right now. And it's being driven by the administration. And when President Trump makes a speech in front of thousands of people at a memorial service and touts tariffs as the best thing since sliced bread, and the average American hates tariffs, you've got a big disconnect. And members of the House have been protected by the speaker from holding votes on these tariffs now through January of next year. So there's not even going to be a check or a balance on the president and his tariff authority from the House until January. They just passed that rule last week. And that's going to be something that they have to decide. Are they going to go on record saying that they do support the collection of $4 trillion in tariffs over a decade that is a tax on the U.S. consumer and is making all of our prices higher? Or do you want another option? Fortunately for the Republican Party, the Democrats don't have a message, but that's basically where we are.
Henrietta, appreciate it. And the brutal honesty at the end, which most people would agree with. Henrietta Treyz there of Veda Partners, thank you very much. The Republicans need what a lot of people in this market are pricing. It's the re-acceleration in the economy. These big companies with big spending plans, we want to see that early next year and see the results from it.
The problem here, and this is something that we've talked about extensively, is it consistent to see companies making bigger and bigger profits, that you also see commensurate job growth and also salary growth? Because what we've seen is companies continuing to beat expectations, and yet the job market remaining really slack. And that, I think, is something people struggle with.
There's a huge disconnect between earnings growth and payrolls growth for 2025, which, if it spills into 26, could have its own problems. Coming up on this programme, the former White House trade official Kate Kalutkiewicz with US lawmakers on a rare trip to China. Plus, Danny has your morning movers and single names rising on gold's record rally. From New York City, this is Bloomberg. Two-day winning streak on the S&P 500. Slight pullback this Monday morning. We're down a third of 1% on the S&P. Down a third also on the Nasdaq 100. If we switch up the board and get to the bond market, 2s, 10s and 30s. 2s essentially unchanged through last week. Anchored between 350 to 360 as the story and rate pricing stabilises. Look out for the Fed speak through the week. Very intrigued to find out Chairman Powell's personal view of things and whether there's any daylight between what he offers with us in a speech this week and what we heard from him in the news conference just last week.
Yeah, does he lean even more hawkish, essentially, to push back, or does he really lean into the idea that this is a labor market that is at risk of turning over? Does it matter? I think that that's the interesting question also. How much does he really hold a disproportionate amount of clout over this committee, given the fact that his term is up early next year.
There is an expiration, and it's May. And once you get past that, arguably once you get somewhere close to it, we're going to stop listening to what the chairman's got to say on the outlook. I think that date is closer to December than it is to May. And once we get closer to year end and they start putting out their outlook, I'm going to be far more interested in whoever has been nominated and appointed to be the next Federal Reserve chair as they go around the media and tell the world what they think.
But this is the reason why I actually think it's not just Fed Chair Powell, it's also Williams, it's also Waller, it's also Musalem, it's all of the other members of the Federal Reserve who are going to be speaking this week. How much are they prepared to push back against a Fed chair, potentially, who is willing to run an economy very hot and look through inflation? What are the parameters at which they start to get more concerned and are willing to say, hold on a second, not so fast?
If you're keen to hear from one of them, you will almost certainly hear from them in the next 24 hours, because pretty much everyone's speaking Monday through Tuesday. As we count you down to that and the opening bell. The opening bell about 2 hours away. Let's get you some morning movers. Here's Danny Berger with more. Hey, Danny.
Hey, John, we're learning more about the contours of this TikTok deal. Some movers off the back of that. For one, early this morning, learning that Oracle would be replicating the TikTok algorithm and providing the security for it. So those shares up about 0.75%. It's had a huge run up, so not totally surprising. It's not moving more. But what is new is a rally in Fox shares, with President Trump going on Fox News saying that both Lachlan and Robert Murdoch are likely to have some sort of role in this TikTok deal. So those shares up about 4.2%. Elsewhere, some deal news this morning. Pfizer pushing into obesity drugs, and it tried to go at it alone unsuccessfully. So it announced that it will be buying Metsera. It's a $7.3 billion deal. They make an obesity shot that key, unlike other ones that you have to take weekly, you only need to take it once monthly. So that makes it more attractive. So those shares up 60%, Pfizer up 1.5%. Meanwhile, that record run in gold shows no signs of stopping, trading about $3,700 this morning at a new record. You're seeing the gold miners play along this morning. The likes of Newmont, Anglo Gold, those are both up at least 1.8% this morning, John.
What a run we've seen for gold. Danny, appreciate it. Danny, thank you very much. More from Danny in the next hour. Gold year to date up 42%. What a move.
And if you want to see any real dollar depreciation, check it out versus gold. And how much are these stories related, given the fact that the likes of the Chinese Central Bank and many others are increasing marginally, and then not so marginally, they're increasing their holdings of the precious metal.
All-time highs, record highs, up again this morning by more than 1%. As the price action cross-asset and across the single names this morning, on our radar this morning, Oracle landing a deal to recreate and provide security for a new US version of the TikTok algorithm. President Donald Trump saying the Murdoch family will be part of the impending deal to buy the app from its Chinese owners. Elsewhere, President Trump raising the annual fee for H-1B visas from $215 to $100,000. The change is expected to have the biggest impact on the tech sector. The White House clarifying the new fee will not impact existing holders of the visa. And finally, the UN Security Council meeting today for talks after Russian fighter jets flew into Estonian airspace just last week. Earlier this month, NATO fighter jets shot down Russian drones that violated Polish airspace.
So once again, you have Estonia, another NATO member, on top of Poland, requesting this Article 4 consultation in recent days. I think a big question is, this continues to happen, even though the Russians say that it's not happening. This continues to happen. What are going to be the repercussions? Is these types of incursions, is this a line in the sand for the President of the United States to do more when it comes to really going after Vladimir Putin?
How many lines in the sand can there possibly be? I mean, there's been line after line after line about the idea of negotiating a deal by this deadline, 2 weeks, 2 weeks, 2 weeks. And so now you have the Europeans actually trying to curtail some of the purchases of Russian gas, natural gas in particular. At what point does the president act, and how much does President Trump's being here in New York City remove him from Washington, D.C., where there's a group of Republican senators trying to force his hand? I mean, this is sort of this interesting moment. At what point does the U.S. get more involved?
Well, I think the president set out the way he thinks about things. He'll get involved, more involved, and lean in, double down, triple down, put all the sanctions in the world on the Russians and others if the Europeans move first. They want the Europeans to do more about the consumption of Russian energy. Both oil and a much bigger issue is Russian gas. And the fact that we're still sitting here several years later into this war, one of the biggest contradictions of this war, the very fact that the Europeans are still consuming Russian energy and funding which is an uncomfortable way of framing it, I know, but it's an accurate one. Essentially, to some extent, funding the Russian war effort by buying Russian energy is incredibly problematic and something that needs addressing.
Including countries like France. There are countries in Europe that continuously import Russian fossil fuels, and they're just having these discussions about trying to wean themselves off natural gas. That could happen as early as 2027. We're not even talking about next year, 2026, and this war is years in. So the president's going to go after all of these countries, because his point is, why should the U.S. do more to protect you when you, to your point, it's uncomfortable, but it's the truth. If you are buying Russian fossil fuels, you are funding this war. And by and large, it's mostly China and India as the top. But at the same time, there's a war on European soil, and the Europeans continue to buy your product.
Yeah, about a fifth of all natural gas, I believe, in Europe still comes from Russia. So it's a significant amount. I will just say that this is what Vladimir Putin was betting on, that the political divisions were enough to keep everyone apart. And the idea is you can't really wrangle some sort of political high ground if you've got your constituents screaming about energy costs. And so that really creates a difficulty getting Europeans on board to execute what President Trump is asking.
I imagine Beijing is super happy with where things are at. Right now, that's for sure.
I think a lot of the countries that are looking at the divisions being a benefit to them.
Let's focus on China. A group of senior US House representatives meeting with President Xi's government in a rare trip to China. The visit seen as another step towards a planned meeting between Trump and Xi at the end of October. The former White House trade official Kate Kalutkiewicz joins us now for more. Kate, welcome back to the programme. Let's just talk about this planned meeting between Xi and Trump by the end of October and the different approach. The president likes to negotiate in real time. He's a deal maker. President Xi takes the more traditional approach to diplomacy, where everyone else does the hard work. You get 99% of the way there, and then you have a meeting. What's going to be the approach from both of these leaders?
Well, I think first, to take a step back, I think we have to recognize that we are a bit delayed in this face-to-face meeting. You know, early on in Trump's administration, we had signaling that the president would travel to Beijing in the fall. And instead, we have this sideline meeting in Korea, of all places, for the two leaders to meet. So I think already we're a bit delayed on this trajectory. So that does color whether or not we can see any real outcomes. But I think you've described the negotiating dynamic perfectly. I mean, in this case, they'll be on neutral ground, and that means something. Neither of them will have the upper hand by hosting the other. So I suspect the meeting in Korea will be just another delaying tactic as we inch towards some real meaningful deal.
But China wanted the president to come to Beijing before he went to APEC. It seemed like the White House was more interested in a sideline deal in APEC. Why?
Well, I think originally President Trump was very interested in traveling to China. That always seemed to be something he was willing to consider. You'll remember he had a very successful meeting, from his perspective, of course, during his first administration to Beijing. And I think he's anxious to do that again. The fact that the first meeting now will take place on the sidelines of APEC means to me that there is not enough substance yet for the president to go to Beijing. Remember, when leaders get together in these huge events, they want something very flashy to announce. And the fact that they're not going straight to Beijing signals that they're not ready.
So potentially we have this TikTok deal playing in with the trade agreement. Do you have an understanding of whether or not Beijing is going to fully relinquish control of the algorithm of TikTok?
It's very hard to predict, but I think that China really has no intention of severing its hold on TikTok. I mean, I think what we continue to see, much like with the tariffs and the rest of the subjects under discussion, is both sides indicating that they're getting what they want as we continue to delay. Now, remember, the TikTok deal, was supposed to come sooner. Congress passed a law banning TikTok, gave the administration 90 days, and they said one time you can delay. So TikTok is already supposed to be banned in the United States, and now we have another delay. So neither side, I think, seems to feel any pressure to continue to move. Certainly the Chinese are getting the signal from the Trump administration that they'll keep delaying, even though Congress has passed this law. So I suspect we're not that much closer, despite the protestations from both sides, that we're going to have a deal.
Kate, this actually is fascinating to me, especially because a lot of people who we spoke to on this show earlier this morning said that they see this pretty much as a done deal. And it seems like this deal is almost certainly going to go through. If this is the state of things, that both sides are saying they have a deal, both sides are saying, sure, it sounds good, and essentially it's just a huge can-kicking exercise, what does that mean about the state of the discussions currently between China and the U.S. on broader issues?
Well, I mean, look, it signals to me that both sides are looking to say things are going well. That's a good thing. And if at the end of the day we have a TikTok deal next week or in 6 months, this still shows that we're talking, and that's important. Neither side wants to escalate. And that's what I take away from this TikTok discussion. That's what I take away from the tariff discussion, and the fact that both leaders signaled in their own ways that they are going to meet. So at the end of the day, again, it's very difficult to predict the minutes, the days, the hours, but the overall posture here is one that neither side wants to provoke. Neither side wants things to change dramatically. They're comfortable in this sort of detente, and I think we'll keep moving that forward. Now, I think the bigger issue here is that neither side knows at the end of the day what they hope to achieve in the broader economic and security relationship. So as long as we're talking, as long as we're delaying, I think that's probably the best we can hope for right now.
Kate, before you go, I would love your thoughts on the H-1B visa issue, especially ahead of the Indian delegation coming to Washington, D.C. to discuss trade relations. How do you view the recent announcement, the announcement over the weekend about the $100,000 cost for H-1B visas right ahead of some of these discussions?
Yeah, it's really odd signaling, frankly, in the sense that the president and the Commerce Secretary, Howard Lutnick, are constantly talking about the need for foreign investment in the United States, particularly in the types of sectors that need highly skilled workers, that the ones that benefit from H-1B visas. So it's a strange signal, to be sure. I have to wonder if there isn't some deal to be made potentially for companies that are willing to make very high investments. Perhaps they could get some sort of, deal on the H-1B visas, because it's very hard to see how these things actually support one another.
Kate, appreciate your take. Thank you. The former White House trade official, Kate Kalutkiewicz there. We heard that from Henrietta Treyz of Veda Partners. It's going to be interesting to track who gets the exemptions and who doesn't, and what kind of different approach we'll see down in Washington, D.C.
Right now, the market is not treating this as a done deal. The market is not saying, OK, this is the new reality. Everyone has to pay the $100,000 fee. So the question is, who essentially gets a leg up as a corporate actor in the United States as a result of an exemption, and who doesn't?
What did Terry Haines say? The lobbyists were scrambling the jets over the weekend.
Yes.
Found that one.
Yeah, exactly. And that they will get back in order, and they will start to lobby in hard order.
If you're just joining us, welcome to the programme. Equity's doing OK. We're down about 1/3 here on the S&P 500. Let's get you some top stories, some news worldwide with your Bloomberg Brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. New details on the deal to save TikTok in the US, as you've been speaking about. Oracle will recreate and provide security for the new US version of TikTok's algorithm. According to a White House official, ByteDance would lease a copy of the algorithm to Oracle, which would then retrain from the ground up. ByteDance would not have access to information on TikTok's US subscribers. Saks Global, the owner of storied retailer Saks Fifth Avenue, is reportedly exploring selling 49% of Bergdorf Goodman for about $1 billion. The Wall Street Journal is reporting there are at least 4 potential bidders, including unnamed Middle Eastern sovereign wealth funds. In sports, baseball's home run race is heating up after LA Dodgers phenom Shohei Ohtani hit his 53rd of the season against the San Francisco Giants. He now ties the Phillies' Kyle Schwarber for second place in the MLB, but Mariners catcher Cal Raleigh still leads the league after hitting his 58th blast of the season as Seattle completed a sweep of the Houston Astros. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on the programme, counting on cuts.
I thought the Fed's decision was a good one. This looks like a sequence of 3 moves in a row through the end of the year.
That conversation up next with Kelsey Berro of JP Morgan Asset Management, live from New York City. You're watching Bloomberg TV. Getting tons of research this morning. This from the head of the Bank of America Institute, Liz Everett-Chrisberg. We're trading airfare for fire pits. Check this out for a headline. Camping is booming, Bramo. Spending at campgrounds rose 15.1% year over year the strongest growth since early 2022.
Some people might say this is a counter indicator. So if people are skipping the hotel room and going camping, that might be something bad. But I personally think that it's just because we're really enjoying nature and we're getting back to our roots. And John, I think we should go on a surveillance camping trip.
Is it camping or glamping? I will definitely not go camping. But
I'm not going camping.
Well, we go glamping.
Look, I'll
Not a
drive.
chance.
I'll get
Not
the different lanterns.
Nope.
You'll each have
You're
it.
gonna put up the tent?
I'll put the tent up. It'll be great.
Bank of America is saying people are drawn by affordability and the wellness focus vibe. I
See?
think the affordability piece of this, trading the airfare for the fire pit, is the potential story here.
Right, the idea that you're downshifting, so it's sort of like going to Dollar Tree or camping. But I would just say the wellness component is a real one, and I recommend it.
There was a reason I brought this up, and it obviously wasn't to arrange a camping trip for Bloomberg Surveillance, all right? Equity futures on the S&P, down by about 1/3%. On the Nasdaq 100, down by 1/3% also. In the bond market, bond yields at the front end. If you haven't guessed, it's a quiet morning. The 2-year, 357. Under surveillance this morning, counting on cuts.
I thought the Fed's decision was a good one. This looks like a sequence of 3 moves in a row through the end of the year. Non-farm payrolls is kind of the key number for the Fed, so I think that made them a little bit nervous. I think that tilted things toward a little bit more dovish policy.
So here's the latest this morning. US Treasuries delivering their biggest annual gain since the pandemic as traders bet on the Fed's easing cycle. Kelsey Berro of JP Morgan Asset Management writing, the low hire, low fire labour market is keeping wage growth moderate, allowing the Fed to ease policy in 25 basis point increments over the next 2 to 3 meetings. Kelsey joins us now for more. Kelsey, good morning.
Good morning.
It's kind of the easy piece of this, potentially, the next 2 to 3 meetings. Then it gets hard.
Yes.
What's the call for 26?
Yeah, I think we're in a critical juncture right now as it relates to the direction for the U.S. economy beyond the next 3 months. So there's kind of 2 ways that this could break. On one hand, you have the labor market, which is clearly weakening. I think it's not just supply. I do think it's a demand. But you have growth data that remains fairly robust and guidance from corporate America that suggests a lot of optimism. So you have kind of 2 ways that can resolve. One way is that the growth data starts to catch down to the labor market data, and the labor market data is the signal. The other scenario is that the labor market data is about to stabilize. The Fed is going to cut rates. Easy financial conditions are already there in the background. And in 3 to 6 months, are you looking at companies that actually want to restart their hiring plans, continue their CapEx, and we could be looking at a Fed that doesn't need to cut rates anymore and an economy that is operating above trend. So right now we're sub-trend. I feel pretty comfortable with where we are now and the carry and credit we have in our portfolios. But there's still a lot of uncertainty about which way the economy breaks in the next 6 to 12 months.
What's the market pricing? Which way does the market believe that this economy is going to break?
I think the market is pricing that the economy is going to break more towards continued expansion and companies that after a period of pause start to reinvigorate their activities and start and that labor market weakness that we're seeing is temporary. And the way that I see that is I like to look at what the market is priced in terms of the Fed. And I think the way to look at it is you look at the median and you also look at the most hawkish and the most dovish. Right now, for the next 6 to 12 months, the market is priced somewhere between the median dot and the most dovish dot. So still reflecting the fact that the balance of risk for the Fed is more likely that they cut faster than they don't cut at all. But then if you look at the longer term trajectory for the Fed funds rate, it kind of looks like we sometimes call it the Nike swoosh, because the policy path starts to turn up. And if you look at what the market is pricing for the long term, the market is actually slightly above the most hawkish expectation for the Fed funds rate in the long term. And that reflects some of that longer term optimism around growth prospects that has kept yields structurally higher in this environment.
So what you're saying is actually really interesting. The idea that long-term rates potentially could go higher in a reacceleration trend. What you're saying suggests maybe that's not the case. Maybe that long-end rates right now, as they are, even with yield curve flattening, are already pricing in that reacceleration. And actually, if you get some sort of real deceleration acceleration in the labor market, you get a bigger rally. Is that what you're basically leveraged to?
Yeah, I mean, I think that speaks to the asymmetry in the value and owning duration. So I would say that the path that the market is priced for the Fed in the short term is, priced fairly to the trailing data. But where we still see that there is valuation opportunities is in those long dated forwards where they are very elevated. They are pricing in a lot of optimism. And then on the other hand, a lot of people have been concerned about the structural supply demand dynamics in the Treasury market. Are there going to be foreign buyers coming in? So far, we've seen that the demand for fixed income is there. The other concern has been around the mix of Treasury supply. And that's not even just a trend in the U.S. The long end has had question marks around it across most developed government bond markets. And what we're seeing there is signs that debt management offices and the Treasury in the U.S. are actually probably going to be more active in terms of shifting their issuance to where the demand is, which we see still in the 5 to 10 year belly of the curve.
Kelsey, can you give us some more detail on that? What has the Treasury been doing more recently that's enabled this market to reject the supply fears? What have they changed?
Well, they haven't actually changed anything. It's about market sentiment around those things. So one is that you've seen very strong auctions generally. There's been a few exceptions. There was a pretty poor TIPS auction last week, but generally the nominal auctions for the long end have gone very well. The other thing that has shifted in terms of perception is now we have the roadmap for fiscal. We have the one big beautiful bill. We kind of know what we're going to be collecting in terms of tariffs on an annualized run rate. And we can kind of feel at least more comfortable. The deficit trajectory isn't great, but at least, we know where it's headed. And then, while the Treasury hasn't done anything dramatic, they are doing buybacks on the long end. And we do think that over time, they will be able to keep the long end supply stable, if not maybe shrink it as a share of issuance. And you'll see the bill issuance as a share is going to actually be able to rise a little bit.
That together with $350 billion of tariff revenue, and I think we're doing okay, right?
Well, that's the key, right? So if Henrietta Treyz is right and they roll that back, does that potential? Yes, but yes, a lot of people are saying, look, this isn't actually that much of a risk, so maybe we were overstating it earlier this year.
We're still waiting on a court decision on whether or not IEEPA is legal or not. Mm-hmm. I think a lot of people come to the conclusion that they will enact the tariffs in another way, but that'll be a huge hurdle for this administration.
It's so funny how much this year's changed. April 2nd, bond negative. Overwhelmingly, in the week after that, it was bond negative. And here we are at the end of 25, or at least approaching the end of 25, talking about how bond positive the tariff revenue is.
Yeah, my takeaway so far from the year, ignore everything. Just buy stocks. I mean, that's essentially what people in the market have been doing.
Kelsey, it's good to see you. Thanks for dropping by. Kelsey Berro there of JP Morgan Asset Management. Stocks a little bit lower this morning, down by about 1/3%. Up next, we'll catch up with Venu Krishna of Barclays, Ingka Group CEO Jesper Brodin, and we'll speak to Jens Nordvig of Exante Data.
There's no sign of that mass liquidation that people were talking about in the second quarter.
There is this hopefulness in equity markets that we are going to get through all the risks.
There is a huge amount of good news that's been priced in.
Small cap has had a few head fakes. We're finally seeing that all-time high.
We've actually seen a broadening of the S&P rally.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. You're opening bell about 90 minutes away, with equities pulling back by just 1/3% on the S&P. Coming into Monday, at record highs on the S&P and on the Nasdaq too. The Nasdaq 100 down by 1/3%. In the bond market, the scores look like this across the yield curve. 2s, 10s and 30s pretty much unchanged. Yields down at the front end of the curve by a basis point, 356.51. Some data to look out for. Look out for the PMIs. We're looking for signs of a re-acceleration in this economy going into September, but also look out for the Fed speak. Chairman Powell, a few days away.
Yeah, tomorrow Fed Chair Jay Powell is going to be speaking, but everyone's going to be speaking this week. So if you're worried about Fed Chair Jay Powell and his relevancy, well, you've got Stephen Myron later today. And if you're worried about him maybe not going to be there early next year, well, John Williams is speaking today as well as almost everybody else. So here's the question. How much will this matter? How much will people be looking at all of the Fed speak to understand just how dovish they are willing to be, just how much they are willing to look through any kind of inflation?
Already this week, aren't more people interested in what Steve Myron has to say this afternoon than what Jay Powell has to say from Rhode Island tomorrow? He said last week he would offer a detailed rationale for his view at the meeting at last week for the FOMC. Well, we're going to get that detailed rationale today. And this is someone who is the future of the Fed, whether it's him or not. It's that thinking that's the future of the Fed rather than Jay Powell, who's up in May.
How persuasive is that thinking for the rest of the committee for 2026 and beyond? We've all got to continue to answer that question. How credible is that thinking with financial markets? How persuasive is it on the committee?
Fed Chair Jay Powell said not very. That's essentially what he said in the press conference. He said, ultimately, this is a committee, and if a member disagrees and dissents, they have to convince everybody else. And ultimately, that is going to either sway the committee or not. That said, how much has this market already moved on and priced in that this is going to be a Fed that's going to look through any inflation because Stephen Myron is more of the mainstream rather than the outlier? And that, I think, is going to be an increasing question, especially as people start to get worried about bubblicious types of trends.
Yeah, look, Chairman Powell's talking about two-sided risk. There is no risk-free path, and the market's focused on one risk, upside risk. And we've seen that in note after note, just this morning alone.
Yeah, up, and up. And the idea of upgrading further. A question of what could potentially stymie this. And yes, people are going to say you're a negative Nelly because you're coming out record high, and you say, this makes me nervous. But at a certain point, it has to start making people nervous when you wonder how much valuations have gotten ahead of themselves given how predicated it is on this type of response function from the Federal Reserve.
Equity futures this morning down by just 0.3%. If you're just joining us, coming into a new trading week once again at all-time highs. Coming up this hour, we'll speak to Venu Krishna of Barclays as stocks trade near record highs, the CEO of Ingka Group, Jesper Brodin, as consumers are remaining resilient, and Jens Nordvig of Exante data as investors await a fresh round of Fed speak this week. We begin this hour with stocks steady to kick off the trading week. Venu Krishna of Barclays writing, we've increased our year-end 26 price target to 7K from 6,700. We expect US tech valuations to continue reflecting constructive investor views. Venu joins us now for more. Venu, good morning. It's good to see you, sir.
Good morning, John.
So an upgrade to the outlook. Let's start there. What's underpinning that view at the moment for you and the team?
A couple of things. First, the first half has been much stronger than what we expected from an earnings standpoint. Two, if you dig in and see what's driving that, it's tech and financials, which is over 50% weight of the market. And the revisions for that actually are improving. And now we're on the cusp of rate cuts, which incrementally are, of course, positive for the market, right? So I think when you put, and then don't forget that global growth, if anything, is stabilizing. And US will exit this year, economic growth, by our economists' estimates, closer to around 1.8%, 1.9% range, which is pretty healthy. So I think while there's a lot of talk about, valuations being extended, which I don't necessarily agree with, but right now, if you see what is holding the market, it's three things. One is the AI narrative is still very much intact. Two, we are in the cusp of Fed cuts. 2, 3, let's see what happens. And 3, we are entering a period of strong seasonality. Now, that's more of a technical sort of phenomenon. But that said, we do believe that all that is priced in, and I have a hard time seeing how the market can keep grinding higher. But then if you look past this year into next year, we do see earnings improving 10%, and we do see, the market going in the range of 7,000 to 7,800. That's an upside and base case range.
Let's break it down.
Yeah.
Earnings and valuations.
Yeah.
Just want to sit on valuations just for a moment. You said I disagree, they're extended.
Yeah.
So tell me the source of that disagreement.
Yeah, so I think the tendency is to look at the aggregate multiple, which by historical standards looks high. One is, we've done work and it shows that over the last 15 years, there's a structural increase in multiples for S&P, and this is primarily a function of the domination of tech, which has been faster growing, higher quality earnings, better margins, and higher multiples. So that's one. But the other thing we do is you got to unpack the market, and we take a sum of the parts approach. In other words, we look at big tech, rest of tech, and rest of S&P. So if you look at big tech, it's trading right now at about 29 times, right? Looks high, fine, it is true. But it started the year at 31 times. They posted earnings of about 28%. They increased their their net margins by over 200 basis points. They beat numbers by 11 to 12 percentage points. That's one. Rest of tech is trading around 28 times. Now, that's a tad high for rest of tech, But if you remove some extreme names like your Palantir, those sort of highly valued names, it's more reasonable. And in fact, the software part of it has got sold off because of a lot of concern about AI disrupting the business model. So we, in fact, think there's an opportunity there. And then last portion, the rest of S&P, which is called broadly 60% of the market, we really see it as a function. We have a good model for that, which is a function of where rates are, where inflation is heading, economic growth. Based on that, it's trading around 20 times. That's fair value. Remember, just a few months ago, the 10-year was at 4.5%. Now we're struggling to hover around the 4% range. So I think that's the reality. So in other words, I'm not suggesting it's cheap, but I'm saying it's not a rich market. It's a fully valued market.
How predicated is this call on further rate cuts by the Federal Reserve on the idea that yields have peaked and are headed downward?
It's not predicated on that, but it's supported by that, right? Because earnings are also improving. So we do see earnings actually improving next year. Not a lot from this year, but call it around 10-ish%. But where the 10-year absolutely happens is that fair value I talked about, that definitely gets impacted by the way the 10-year is. You're always concerned about the correlation of rates and equities. And I think what we have found is that we get worried when the 10s breach 4.5% and start heading towards 5%, but there's a very distinct negative correlation we've observed over a very long period of time. On the flip side, when rates are already low, then you're concerned because of the destabilizing impact of deflation. Right now, we're in a sweet spot where we have some amount of inflation, which is not necessarily bad, which actually strengthens the ability to do some pricing on the pricing power front. We have economic growth, which is moderating compared to 23 and 24, but still relatively robust. And you have corporate earnings which are very strong. And most importantly, what has happened is the tariff effect, which even we estimated, has proved to be a little less worse than what we thought. It probably got pushed out a little bit, but companies are figuring out, and most importantly, based on the transcript work we have done, it appears that in their guidance, they are already taking into consideration the mitigation steps. And so the guidance is relatively safe at this point.
This is so much optimism, I can't even stand it. I will just take one issue. This idea of seasonality. Yeah. Everyone said that September was a bad season. It's always a bad month. Well, we're up more than 3%, and it's poised to be the best September going back to 2010. Has seasonality broken?
Well, in the recent years, it has. Even last year was the same story. August and September was pretty good. Historically, it's bad. But I would argue that why just seasonality now? Everything is long-term relationships have broken quite significantly post-COVID. You have a negative yield curve for a long time, inverted curve. Did we have a recession? No. We had PMIs in the negative territory. Did we have industrial recession? No. Did earnings collapse for industrials? No. Right? But it doesn't mean they're not risks. So a lot of relationships which we thought existed are simply not true. Right? And it doesn't mean that you shouldn't worry. It just means that, if you say this time is different, you got to take it in blocks and see, what next. And so right now, at least for the next 12 to 18 months, we don't see significant catalysts for destabilizing where we are right now.
So do you find policies like H-1B visas, the tariffs, they're still being legislated in courts when it comes to IEEPA? Do you find DC policy supportive, or are they headwinds next year?
No. I mean, one of the biggest concerns this year has been the level of policy uncertainty. But what is amazing is that the market has learned to look past it and to see, the extent of rhetoric, how long it lasts and goes on. I mean, you saw even the H-1B thing. We had data shifting over the weekend, right? First, the news was more draconian, and then they came back and clarified that it's one time and it's not for renewals and things like that. So I think policy uncertainty is something we have to learn to live with. What we have to watch out for, where it oversteps acceptable boundaries of the market, right? And so that's where I would actually watch the rates market more for that, to see if and when the discomfort is there. I mean, to talk about deficits is the biggest concern right now, right? And what is your 10-year doing? It's down. It's not up, right? So term premium has actually come down. So I think you start looking at those things and say that to what extent is the magnitude of policy uncertainty going to hurt the market? And so far, I think it's a risk, but it's not an overwhelming risk thus far.
Venu, what's amazing is what you said about earnings for next year, EPS revisions. It's been a huge focus of this programme for quite a while now, that we've had this step down in payrolls growth, massive step down in payrolls growth. And maybe it's been building for a whole lot longer than people realised. And yet you're still seeing this step up in earnings revisions, which makes me wonder just how relevant this is, which is an uncomfortable conversation for anyone following this right now, sitting at home saying, well, it's relevant to me, it's relevant to everyone. Everyone needs a job. But at the moment, we're seeing that tension just grow, get bigger and bigger. How relevant is the payrolls number to the broader market and to earnings?
It is relevant. And that's why talking about, this market is highly bifurcated. That's why I said, if you look at where the earnings strength came from, it came from just two sectors, tech and financials. And that's where the divisions have been. If you looked at the rest of the 8 or 9 sectors, 90% of them had negative operating leverage, in which their cost growth was faster than the sales growth. So we should not lull ourselves into thinking that everything is hunky-dory across markets. It's not, right? And that's where we're paying attention. That's why even in our outlook, when I take the sum of the parts approach, we're a lot more bullish on the tech front, and we are very positive on financials. But compared to consensus in the street, we're a lot lower on the rest of the economy. So, how does the rest of the economy get impacted by all this is important. And to your point about the labor market being, your tech companies are laying off people by the thousands, but their net margins have improved by 200 basis points. And their earnings are off the charts. And on a PEG ratio basis, when you say things are rich, it's kind of 1. And the range is 1 to 1.6. So what are we talking about?
Do you think the tech sector can continue just to trade on an island? It can just be its own beast, this big secular theme that's detached from the cyclical story? Or do you think when they do finally face a cyclical test, people might be surprised by just how resilient they might not be?
Well, they will face a cyclical test. It's not happening in the next 18 months. And we're doing more work. Look out for that.
Sure.
We're doing some excellent work on that. But the interesting thing is the tech's impact now is spreading across a wider cross-section of the economy. So, for example, when you talk about even big tech and all the CapEx spending, it is not just the big hyperscalers right now. It's gone into utilities. It's gone into component manufacturers. It's gone to industrials. So it's spread. So to the extent that tech is negatively impacted in terms of the scale of the business, it'll percolate to some extent. So, yeah, it's a mixed bag. But look out. I think probably we should come back and talk again.
Well, I'll look out for your research piece. Before you go, we really wanted to squeeze in your view on small caps.
Yeah.
We've had this massive rally. You've talked about the lack of broadening out for earnings revisions. Small caps have rallied almost exclusively on a re-rating of the rate cycle, the rate cuts, the repricing of that over the last, let's say, 2 months, since early August when we first had that really weak July payrolls report. Are you seeing anything beyond the rate cut story to justify the rally we've had over the last 7 consecutive weeks?
For the first time, we are. And let me paraphrase that we have been negative on small caps for the longest period of time, right? And it's not worked for the last 2 decades. I still am very skeptical. I think it's more of a rental trade or a tactical trade rather than a long-term strategic trade. The reason I say that is, yes, rate cuts have been one of the huge booster for them. But if you start looking at the SML, which is the more profitable portion, 400-odd companies from the Russell universe, we were surprised to see that they actually had some modest sales decline, but managed to post pretty solid earnings on top of that. And their revisions have improved, and actually their revisions have gotten slightly better than the S&P outside of tech, that portion. So I think there is some fundamental strength, which is going consistent with the recent rally. I just worry how long it's going to last, especially for things like tariffs, which have not fully shown yet. I think it's going to percolate over the next few quarters. Business-wise, there's less flexibility. The other thing is, with the 10-year coming down and front-end rates coming down, with a lot of floating rate debt, they do benefit in the short term.
Venu, it's good to see you.
Thank you.
Thank you, sir. Appreciate your time. Venu Krishna there of Barclays on a better outlook for 2026, and maybe small caps, certain parts of small caps can do okay. If you're just joining us, welcome to the programme. Coming into Monday, close to all-time highs and just pulling back a touch by 0.25% on the S&P 500 to 1/3 of 1% through most of this morning. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Oracle is announcing big changes to its leadership. Clay McGurk and Mike Cecilia have been named as co-CEOs, replacing Safra Katz, who had been in the role since 2019. McGurk previously served as president of the company's cloud infrastructure, and Cecilia was the president of Oracle Industries. In a statement, Oracle chair Larry Ellison said the men are both proven leaders. New rules are now in effect for those seeking high-skilled U.S. visas. On Friday, the Trump administration imposed a new $100,000 application fee for the widely used H-1B program. The new rules are expected to have a significant impact on Indian nationals who account for more than 70% of all H-1B visas. Airports in Berlin, London and Brussels face continued delays after a cyber attack on a key airline check-in system. The outage stemmed from a cyber incident at Collins Aerospace. Passengers at several airports had to be processed manually. Brussels Airport asked carriers to cancel some scheduled departures. And that is your Bloomberg Brief. John.
Bonnie, thank you. Appreciate it. Up next, the morning calls as we count you down to the opening bell. 1 hour and 13 minutes away. Equities just a little bit softer. Live from New York City this morning. Good morning. The opening bell 1 hour and 10 minutes away. Equity futures a little bit softer here. We're down by 1/3% on the S&P 500. That's the price action. Let's get you some morning calls. First up, Dan Ives of Wedbush raising his price target on Apple to 310, seeing early signs of strong demand for the iPhone 17. That stock is up by 0.6%. Your second call from Piper Sandler raising its price target on Tesla to 500, saying the company is its top idea for investing on autonomous vehicles. And finally, Citi raising its price target on GM to 75, citing the company's leverage to positive trade agreements. That stock just about unchanged so far this morning. Let's stick with trade. The furniture industry facing global headwinds, yet consumers are remaining resilient. Jesper Brodin is the CEO of Ingka Group, the largest IKEA franchisee operating most of the brand stores. Jesper joins us now for more. Jesper, welcome to New York. It's good to see you.
Wonderful to be here.
How are things going? Because we heard from Restoration Hardware and the RH CEO was on the earnings call dropping F-bombs. And I imagine a lot of people are having similar issues at the moment trying to sell furniture. You're at a different price point. What's your experience this year?
Well, to be honest, when it comes to our customer and clientele, these are people with thin wallets out there, the many people. And normally tough times is when more people come our way. At the same time, people have less money. We see this for a year at least globally. So many things going on. You can say still recovery from the pandemic when it comes to inflationary measures. But then again, our line of business is really about human basic needs. It's about the bunk bed when the kids grow up. It's about the chair and table and so on. So business is okay. It's growing. We're growing customers and sales of pieces, but it's not easy.
Well, people want the $149 bunk bed for their kids, which they can then disassemble when the kids hate each other. I'm just wondering, from your perspective, how hard it is to pass along the extra costs that are getting incurred currently from different tariffs, different regulatory regimes, et cetera. Are you able to pass that along in a way where consumers are okay with it?
I see your point. To be honest, the last 8 years, as I've been CEO, has been chaotic from a cost and inflationary point of view. Nothing compares to the impact of the inflation, to be honest, where we have like the most incredible unbalances in trade and prices. We had to, for a certain while, actually recover some of the inflationary damage that we had. Since then, we in IKEA have actually been able to lower our prices and compensate back to an inflation-adjusted level. And last year, we did a record investment in lowering prices with $2.2 billion US. So we actually, the strategy of IKEA has always been about bundle volume, make sure we make things better, take out waste, which is also, I think, one of the reasons I'm here, being here for the Climate Week, but actually lowering the prices.
When you say invest $2.2 billion, does that mean take it on the margin?
So actually, when we say invest, you're right, actually, people wonder what we mean. So for us, we're actually here to serve people with thin wallets. So investing in lower prices means we grow our business and make more people able to actually access IKEA. So actually, we've always been about low margins and reaching more people.
You're here during the UN General Assembly Week. How have tariffs, geopolitical tensions, How has that changed the landscape for where you actually source the material?
So companies like IKEA, I think, well, it's interesting because it used to be, when I grew up in business, it used to be so that companies were fast and governments were slow. This is no longer a reality.
For this
so when IKEA, basically, when we build our strategies, we are too large to adapt over a few months or to new situations. So we are slow builders. When it comes to the US, our strategy is actually to go denser in US. A decision was taken about 3-4 years ago to invest heavily into. We're actually investing over $2 billion in US since 2023. And the reason is that we need to be in more places. We need to be closer to customers, and we need to build production in this country in order to actually leverage our business model. That is over a 10-year period, so it's difficult for us to adjust our strategies short term.
Being here earlier than we see some of the waves of some companies, have you been able to blunt some of the tariff impact?
So we are actually always trying to lower our prices in IKEA. When we look at the tariffs, is obviously one of the factors right now that is impacting our business in this market, but also in other markets. But it's not the only one that we are addressing at the moment. The most, I would say, challenging but also interesting dimension of our value chain is actually climate. So when you look at IKEA's work to actually adapt to the Paris Agreement and make sure we deliver, the interesting thing, which I find still, I think, a bit lost in the dialogue when it comes to rooms like we are sitting here and in other places, is that climate smart means that you take out cost from your value chain. So IKEA is today actually lowering our prices and improving our P&L by being climate smart.
Annmarie had one final question. As soon as you walked into the room, what was your question?
How are the meatballs?
How
and you're
the
lowering
meatballs?
the cost of the meatballs,
so I am myself, I'm an intellectual vegetarian. I normally say down here I struggle. I love the meatballs. We're actually running today about 40% of our sales is actually veggie balls and plant balls. And personally, I don't love the veggie balls, but the plant balls is a great exception. But meatballs is part of our legacy, so there you go.
I love your honesty. Jesper, appreciate your time.
Thank you so much.
Thanks for being here. Thank you, sir. It's great to catch up with you. Jesper Brodin there, the Ingka Group CEO.
I got to say, plant balls don't have the same ring as meatballs. I'm just saying. I mean, would you, if I said to my kids, I'm making spaghetti and plant balls.
That's not going to work.
That wouldn't
work with me either.
Yeah, I mean, just, I'm just wondering.
We got a little bit left, 10 seconds. You want to squeeze something in or you're done? Okay, you're done. All right. Jens Nordvig of Exante Data joins us next, live from New York City. This is Bloomberg. The opening bow is about 60 minutes away. Equity futures going into the cash open on the first trading day of a brand new trading week. Slightly negative. We're down by 1/3% across the board here on the S&P. Likewise on the Nasdaq 100. The Russell a little bit softer by 0.2%. As we count you down to that opening bow, let's get you some single names, some morning movers. Here's Danny with more. Hey, Danny.
Hey, John. Some breaking news from Oracle at the top of the hour, changing up their leadership structure amid all that they have going on with AI to TikTok. Two new co-CEOs will be taking over, McGoyrick and Cecilia. One has a cloud infrastructure background, the other one an AI background. So really marrying the two together, it shows you where the concentration and future bets of this company. The prior CEO stepping down is Katz, so shares slightly lower off the back of that, down about 1.1%. Elsewhere, Fox shares to the upside this morning, up by more than 4% after President Trump took to Fox News saying that Lachlan and Rupert Murdoch would have some role in the new TikTok, the new U.S. version of TikTok. So again, shares higher off the back of that. Finally, some deal news this morning. Pfizer, in a $7.3 billion deal, will be buying Metsera. They are the maker of an anti-obesity shot. Key to why this one's attractive, you only need to take it once a month. Most of them you need to take it once weekly. So those shares up 60%. Pfizer, now that it gets to participate in the obesity market rally, those shares up 1.7%, John.
Danny, thank you. Appreciate the update. More from Danny alongside Matt Miller. Bloomberg Open Interest about 30 minutes away. Look out for that as we count you down to the opening bell. A busy week of Fed speak coming up. It kicks off today. Mike McKee joins us now for more. Mike, it might be easier if I ask you who isn't speaking this week.
Yeah, it's kind of that way. It is perhaps a world record. We'll let the Guinness people know. 17 Fed speeches this week. not about the data, but it's about what the Fed thinks about the data. Everybody rushing to get their opinions on the record, it appears. We kick off today with 4. There were supposed to be 5 today, but John Williams is under the weather, so he is not speaking. But you can see every day. Wednesday, we just get the 1, but Thursday is a really, really busy day, and hopefully John Williams will be feeling better by then. Income and spending, the one indicator that we're going to care about this week. On Friday, we kind of already know what the inflation numbers are going to tell us. The Fed chair told us during the Fed news conference last week. But beyond that, not a lot of data to move the needle. It's really going to be what people think. Everybody's focused on Stephen Myron today, but he did an interview last week, and he doesn't say anything different from what he said in the past and what he said at his confirmation hearing. So while it'll get a lot of attention, it's probably not going to be very meaningful. What I want to point you to is Jay Powell tomorrow, because what he managed to do in getting everybody on board with just a quarter point and having only the 1 dissent at the last meeting tells you, at least for now, he's still in charge.
Mike, how do you approach that speech from Chairman Powell tomorrow? I want to understand from your perspective whether this is a chairman who will continue to try and reflect a consensus on the committee that may or may not exist right now, or whether we'll begin to tease out his personal views on where he's at personally right now.
Well, I think you get a little bit of both. And the hard part is separating out what the rest of the committee thinks from what the chairman thinks, because he does lean towards getting consensus from everybody. So we will listen to see if he talks about divisions at all on the Fed and how there may be some people who are waiting for data, some people who are waiting for other data. But at the moment, I think he's speaking generally for the center. Now, the center is equally divided almost between 2 more cuts and 1 more cut this year. So he may not take a firm position, but that also tells you something.
Michael McKee, enjoyed the update. Mike, thank you, sir. Looking forward to a week full of Fed Speak. Jens Nordvig, the founder and CEO of Exante Data, joins us around the table here in New York. Jens, good morning. Good to see you. Good morning. It's been a number of months. It's been too long. So let's recap the year so far. You track flows, and flows at the start of the year, particularly through April and May, became a really, really important story. Some might say dominant for foreign exchange. Can we start there? What did you start to see develop, and how important is that story now compared to then?
I would say we've gone through kind of 3 phases where we came into this year where US exceptionalism was still what equity investors globally were doing. So we have a metric where we say, okay, what's all the capital that's moving cross-border and where is it heading? And in that phase, essentially all of it went to the United States. There was no appetite to buy Chinese equities, European equities, or anything, right? And then in March, it started to change. Policy uncertainty in the US was picking up, fiscal stimulus in Europe and so forth. And we had a period, I would say, from March to June where actually it really flipped. Not that much foreign demand for US equities and much more internationally. And then since then, I think we're more in a gray zone. We're not back to US exceptionalism, but also US equity markets have rallied, and there is some demand coming back. So we certainly still focus on that. It's important, but it's not as dominant as it was in the second quarter, right, where the dollar was going down dramatically, first against Europe, then we had the Taiwan move and so forth. So it's more of a nuanced story now.
A lot of people are saying that they want exposure to the United States equity story, but not the dollar. So it's this FX hedging story that's driven the dollar weaker in a significant way. Can that continue, or is that fully priced? Is that something that has been maybe overstated as a long-term trend?
Yeah, I think it's a very important question, right? Because when we analyze what is happening with hedging, right, we can dig out, one data point that shows something very specific. There's been a lot of focus on what's happening in the ETF space in the last couple of months, but the ETF space is a pretty small part of what's happening with hedging. If you think about a big pension fund that is going to change their dollar allocation, are they going to use ETFs? No, they're going to use FX forwards or options, right? So all the data we look at, I think, has a very consistent message, and that is we had a huge shock. Like what happened in April was just very unusual price action. People got scared, and a lot of big institutions took big action. They changed their allocations, and we can see it from many. We look at it fund by fund, literally what did that pension fund do and so forth, right? And there were material changes around April, May. And then most of the indicators shows that there's been a degree of stabilization, right? So when you think about hedging, it's not, oh, now they're starting to hedge and they're going to hedge more and more and more for the next 10 years. It's like, I think it's more of a one-off shift. And then really what we're looking at on a forward-looking basis is just this relative demand. Like, is the relative demand for the U.S. slightly less? It is slightly less, right? Because we had a period where it felt like there was almost no competition for the U.S. Like tech story was the only thing people cared about. And now you have financials in Europe, defense stocks around the world and so forth. There are other narratives that people are buying into. But I think the big hedging shock, we probably had the most of the adjustment already take place. And from here, it's about the actual new flow that is coming in that's driving it.
So what's the pain trade here? And this is something that we've talked about with people, that if you see some sort of dollar strengthening, that could be a real pain trade for all the different investment funds that have been hedging the dollar exposure. Do you see that as being a sort of setup and a potential catalyst heading into year end?
I think that's something that we have learned to worry about for a while. But that's also why what has happened this year is really a bit of regime shift, right? Because what happened in April was that you had, equity market weakness, but the dollar did not benefit, right? So the correlations between the traditional periods of pain where you have, risk assets that are trading very poorly and the dollar does well, that is less so, right? So I think the pain is probably come in a different way. But I think what's really important here is what's happening with the long end of the bond market. In April, you had equities down, long end bonds down, right, and the dollar down together, right? If the U.S. bond market is trading more stable, that's part of the equation that's different from Q2.
So is that like the litmus test of geopolitical issues that individuals are willing to dump U.S. assets across the board for?
That's what we saw for a couple of weeks in April, right? And now I think you're seeing that the bond market is trading better, as we heard from your previous guest, right? Like the equity guys are looking at what the 10-year is doing, and the 10-year has been doing all right. And I think even in the last couple of weeks where we've had a lot of focus on central bank independence, we've not really seen the long end trade disastrously badly, right? We had a couple of days where the Cook news was very much in the headlines, and we had a couple of basis points here and there, but it was not a big trend, right? So there's some resilience in the bond market that I think is a part of the picture, and that removes some of the extreme tail risk for the dollar. Doesn't mean that the dollar is going to be on a bull run, but it removes some tail risk.
At least potentially at the very long end, the leakage, the softness we've seen in the summer wasn't a US story. It was arguably coming from elsewhere, Europe, the UK, France. And I want to finish on Asia, Japan. Japan for a long, long time was the anchor around the global bond market. And when I say a long time, I mean decades, our careers. And I want to understand how the changes there are going to change things elsewhere. The foreign exchange, the demand for foreign assets, whether this money is going to be repatriated, go back to Japan. What all those things mean and how we should rethink this asset class.
So I have this discussion all the time with our institutional clients around the world, right? Because you look at what's happening in Japan, the Japanese yield curve is sitting now at a totally different level, right, that we've been used to for decades. Nevertheless, when we track the flows in Japan, we cannot see any evidence that Japanese investors are really repatriating funds back into Japan. It's almost like the opposite. If you look at the equity flows, a lot of regions around the world had a period where they withdrew back into their own market. But in the Japanese, it's almost every single week they're still putting money into the US equity market. So until that changes, I don't think the yen is going to have a significant benefit from what's happening in the JGB market.
It's that great repatriation people are worried about, still waiting for.
Yeah, they're not happening. It's not happening. Although what it is interesting is every private investment fund in the world is going after Japan right now and buying up their assets because they have more faith in their assets than evidently Japanese investors do.
Jens, it's good to see you. Thanks for dropping by. Appreciate your time. Thoughtful stuff as always. Backed by data. Jens Nordvig there of Exante Data. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John. Thank you. Australia, Canada and the United Kingdom have formally recognised a Palestinian state. This ahead of the UN General Assembly meetings this week. Leaders of the three countries call it a coordinated push for a two-state solution. The move has drawn criticism from President Trump and also from Israeli Prime Minister Benjamin Netanyahu. They argue that it rewards Hamas and threatens Israel's security. New rules are now in effect for those seeking high-skilled U.S. visas. On Friday, the Trump administration imposed a new $100,000 application fee for the widely used H-1B program. The new rules are expected to have a significant impact on Indian nationals, who account for more than 70% of all H-1B visas. T-Mobile is announcing a shake-up in its leadership. CEO Mike Sievert is stepping down from the role and will move to vice chairman. Current COO Srini Gopalan will become the company's next chief executive. The changes are set to go into effect November 1st. Both Sievert and Gopalan will join Bloomberg Tech tomorrow at 11 Eastern. And that's your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Thanks for this morning. Up next, we'll set you up for the day ahead. Plus, we'll catch up with Bill Campbell of Doubleline from New York City. You're watching Bloomberg TV.
Just if growth holds up, the Fed cutting into these already easy financial conditions. And then I think also really importantly, the Fed cutting into what looks like a really historic boom in CapEx. And these things might not be, 3% GDP type of numbers, but if the cycle can hold up for longer, it could kind of heat up conditions in our view.
That was Andrew Sheets of Morgan Stanley, bullish on the future. A lot of people are right now, overwhelmingly so. Bullish coming into this trading week. Equity futures pulling back from all-time highs this morning, at least. We're down by 0.3% on the S&P. On the Nasdaq, we're down by about a quarter. That's the equity setup going into the opening bell about 44 minutes away. As we count you down, here's the trading diary. Happening today, a White House press briefing later on this afternoon, plus a slew of Fed speak, including Barkin and Myron. On Tuesday, PMI data followed by comments from Fed Chair Jay Powell and President Donald Trump speaking at the UN General Assembly. On Thursday, another round of jobless claims, plus results from Costco. Finally, looking ahead to Friday, PCE data in between. Look out for the PMIs too. Talked about that a few times. It's an early reading on September. Are we starting to see a pickup, Bramo, in economic activity?
And this is something that we've heard about from a number of CEOs, that they actually saw the weakness earlier this year, and now they're seeing a reacceleration. Is that confined to the services? Is that confined to manufacturing? I think that PMIs is going to be really important.
For the US dollar and for global fixed income, let's look at that right now. Bill Campbell of Doubleline writing the following. The Fed meeting sets up more curve steepening and a weaker US dollar. Interest rates will continue to be cut with inflation under control. Bill joins us now for more. Bill, welcome to the programme, sir. Let's talk about that curve steepening. So the front end story is dominated by interest rates and what the Fed does. Want your view on what's driving the long end right now and whether you and the team believe that the fiscal concerns will return?
Oh, absolutely. I don't think the fiscal concerns have gone anywhere. I think the fiscal concerns are both U.S. focused and international focused. Let's start in the U.S. We're watching for a continuing resolution to pass, but the Senate is going to need 7 Democrat votes to pass just a short-term funding resolution, and we're already seeing difficulties getting that passed. When we look, at the outlook, for the fiscal trajectory for the U.S., yes, we're going to have decent growth and hopefully, pick up further in revenues due to higher growth and tariffs. But next year's an election year, and spending, in our opinion, is likely to remain elevated. I don't think we can discount the international aspect either. We're seeing large fiscal deficits across the developed markets, from Europe, in the UK and France, to Japan, who's going into a leadership election where the candidates are focused on additional fiscal spending. One item that, several items caught my eye, but one item that caught my eye last week was in the UK's, the Bank of England's decision to keep interest rates on hold. They made an adjustment to their balance sheet policy. They decided that they needed to slow the pace of quantitative tightening, and they're going to be adjusting their sales of longer term assets more to shorter term assets. Due to the pressures on the long end of the curve. I think those fiscal pressures across developed markets can bleed through back to the U.S., but are going to be with us across the developed markets well into next year, leading to further steepening of the curve.
Bill, there's so much to unpack there. I just want to start with what's happened over the past few weeks, which has actually been flattening. How do you understand that, given the backdrop that you just laid out?
Absolutely. I think the flattening that we've seen is a bit of a buy the rumor, sell the news on the back of the Fed. Going into the Fed meeting, there was a lot of front running, trying to think. I think a lot of investors were trying to position on how quickly the rate cutting path would come, given the downgrade in the labor market. Jay Powell, although giving us the cut, still seems to be more finely balanced. And I was actually surprised that the only dissent for an additional cut was Steve Myron. I was looking to see what Waller and Bowman were going to do, and it does not look like they dissented for a cut this time around. So I think on the back of that, the shorter term, faster trading segment of the market took some profits on the steepener. We also went through a couple of key levels. So I think that dragged CTAs into reducing steepener positions just a little bit. But I think as investors, what we need to do is separate out what is the medium-term trend from the short-term cyclical trading trend. If you just look very microscopically in the past couple of days, we've started to see the creeping come back into the back end of the curve, especially on the 2s, 30s, where I believe it got down to a low of 114, and now we're back up to about 117. I think that this is probably an interesting place to enter back into steepeners, as it's my opinion that fiscal concerns are going to come back to the top of the headlines, not only with the U.S. continuing resolution, but let's look at what happened in France. We are seeing protests, extremely large protests all around the expectation of their future budget that needs to be passed in a draft format in the next week or two.
Yeah.
I think there's lessons to be learned when we look at the international markets. One of the biggest ones is this rising social unrest or rising social tensions around less fiscal space. And I believe that's going to be with developed market economies over the next, at least through 2026, if not longer. So I think we're setting up for longer term steepening of the yield curve because, one, we're going to have central banks trying to ease where they can. The Fed will be leading the way in this. But then the longer end is going to face not only fiscal pressures, but as central banks cut, trying to keep interest expense under control, that's also going to raise questions, one, about inflation expectations. What is the uncertainty around those? I think that's got to come with an increased term premium. And then we're going to have the questions about Fed credibility and Fed independence as the board, the mix of the board and potentially new members to the Fed are put in place next year.
Yeah, but Bill, some people would argue all of this does sound scary, and it sounds like it's been percolating for a while. And this was the argument earlier this year when you saw a sell-off in the long end of the yield curve. But there's more than $7 trillion in money market accounts that, as the Fed cuts, will migrate into duration, will migrate into credit, will migrate into other assets that can provide that same kind of income. Why is that wall of cash not enough of an argument to really dampen some of the steepening argument?
Well, I think the wall of cash is likely to go more into where we're focusing on, in the belly or front end of the curve, into credit markets and into international markets as well. There are other places besides the long end of the yield curve to put your money. And when we look at what happened post-Liberation Day with the correlations between equities and risk assets and the long end of the curve, I think that is something that a lot of institutions and institutional investors have taken note of. So I think that the fact that the Fed is continuing to lower interest rates, we're probably extending the path of a continued, let's call it, positive economic outlook with a backdrop that is probably good for risk. And that, I think, in my opinion, should support the trade for emerging market local currencies and local bonds. I think when we look at Doubleline across all of the different sectors, we notice that valuations are tight pretty much everywhere except for that area of the market. And we're finding tremendous opportunities to pick up yield and to participate in uncorrelated returns by allocating to the larger, higher real yielding emerging market local currencies and local bonds.
Bill, you're giving us tons to talk about. Let's do it again soon. Bill Campbell there of Doubleline talked a little bit about some of the DM concerns in the debt market. Let's talk about the EM concerns in the debt market. These headlines just crossing from the Treasury Secretary, Scott Bessent, on Argentina.
Yeah, the Treasury Secretary coming out and basically saying all tools are in the toolbox. They will come out and use them. They're going to be meeting Milei tomorrow. He's going to be alongside the president. And this is really the key quote here when it comes to what they potentially could do with the stabilization fund. They include, not limited to, swap lines, direct currency purchases, purchase of U.S. dollar-denominated government debt from the Treasury's Exchange Stabilization Fund. And this grows on something that the Treasury Secretary spoke with Argentina's Milei in April when I was there. And it looks like potentially they're going to have to come to the rescue once again.
Yeah, because once again, Argentina is having a fiscal crisis, and as a result of Milei actually losing a number of elections. So it raises questions about his ability to keep going with some of the initiatives. Argentina is like the perpetual story. I mean, if you want an argument not to invest in an emerging market, I mean, Argentina is basically case study number one.
But I'm pleased you framed things in the way they did. They're not because of his policies. It's because of the very threat that we might not have them anymore.
Correct.
And that someone else might win these elections.
Right, and that could undermine the credibility. I mean, it just shows how unstable things are in that region.
Without a doubt. We'll have more on that region tomorrow ahead of that meeting. Coming up tomorrow, Keith Lerner of Truist, Kristen Bidley of Citi, Liz Ann Saunders of Charles Schwab, and Stephen Stanley of Santander. From New York City this morning, good morning to you all. Have a wonderful trading week. This was Bloomberg Surveillance.